You've got a Wall Street that's waiting for something to break hard in one direction.
Our expectation is that we do kind of see growth slow through this year. We're seeing a slowing in the labour market.
There's still some anxiety, kind of in the system. I think a lot of it, to me, revolves around the labour market.
Realistically, we're just seeing a rebalancing in the labour market that's actually working out fairly well.
There are pockets of vulnerability, for sure. We're seeing that across the board.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with equity futures just about unchanged on the S&P 500. Coming into Tuesday with equities on the Nasdaq 100 at all-time highs and the S&P not too far behind, with a big focus on retail through the next 60 minutes or so. We'll hear from Lowe's, we'll hear from Macy's too. We've already heard from Target, earnings from them tomorrow, and this announcement. Plans to reduce prices on 5,000 items. Bramo, here's the quote. We know consumers are feeling pressured.
This has been a theme that we've heard consistently, yet we haven't seen it show up in the broad-based data enough to give people confidence that we actually are seeing disinflation. And that, to me, really is the reason why Kit Jukes just keeps putting it the best, twiddling our thumbs, waiting for inflation to come down. Maybe retail can give us a better sense.
Barclays, after this, is saying more challenges potentially ahead for Target. Target is saying that they're cutting into Memorial Day. You can maybe expect, if you're a consumer, more bargains also going to July 4th. And we're talking about everyday items. Milk, soda, fresh fruit, snacks, yogurt, peanut butter. And Jonathan, it caught the attention of the White House because Biden immediately tweeted about it.
Surprise, surprise. Let's see if we get more of that going into earnings tomorrow. Looking out for Lowe's in just a second, then Macy's in about an hour from now. We also need to look to the bulls on Wall Street, which now includes Mike Wilson and Morgan Stanley. We'll catch up with Mike a little bit later. Someone who's still bearish, Marko Kolanovic over at JP Morgan, maintaining our bearish stance. Here's the ingredients: high valuations, restrictive rates, inflation, and least of the world in flux. From Marko Kolanovic.
He also did acknowledge a negative stance in equities has hurt the performance of our multi-asset portfolio over the past year, you think? I think it's got to be pretty awkward. At this point, there is this discomfort that even some of the bulls have with valuations. That said, it's getting harder and harder to see the oxygen really come out of the room enough to get down to, what, 4,200? Is that his projection?
You might know who might agree with him. It's JP Morgan. Yesterday, down by about 4.5%. It's the CEO, Jamie Dimon. We're not going to buy back stock. A lot of stock at these prices. That was a standout for me. I know this morning we're waking up talking about succession at JP Morgan. The standout for me yesterday was his view on the price of his own stock.
You're not alone. Pretty much everyone in the market cares a lot more about that than, frankly, even succession, because if you take a look at where the stock price dipped, it was exactly at his comment that he's not interested in buying back stock, given where valuations are
We'll
at.
pick up on that story a little bit later. We'll throw that one at Max Kettner of HSBC. Equity futures in the S&P 500, our scores this morning, just about unchanged to going nowhere. In the bond market, your 10-year yield down a couple of basis points on a 10-year 442.37. In foreign exchange, the euro 108.73. Coming up this hour, we'll catch up with Max Kettner of HSBC as the Nasdaq 100 tops another record high. Stephen Cook of CFR on the death of Iran's president, and former Fed economist Claudia Sahm on the overload of Fed speak still ahead. We begin with our top story. The Nasdaq 100 hitting another record high as investors double down on Nvidia before earnings tomorrow. Max Kettner of HSBC writing this: we think the rally has further legs as short-term investment and positioning is not yet sending a warning signal, and the tail risk of Fed hikes has been taken off the table. I'm pleased to say that Max Kettner joins us now for more. Max, let's get into the bearish view on this equity market and tell me why Marco's wrong. High valuations, restrictive rates, inflation, and the world in flux. What do you say back to that?
Yeah, look, I would say valuations, number one, are not a great tool at all for tactical asset allocations or for tactical views, right? Look, just because you buy an S&P or any equity at a 21 or 20 times earning doesn't mean that it can't go one turn higher. So valuations in the long term, fine. They tend to work over sort of a 5 to 10 year period. Over a shorter period of time, let's say 6 to 12 months, they do a really, really poor job in predicting short-term performance. So I wouldn't really use that as a bearish argument. The second one, in terms of restrictive stance, I really disagree with that, because when we look at real rates, fine, they look restrictive. But in fact, when we look at the US economy in total, over the last 2-3 years, I think we've learned collectively, and I think that was the mistake that we've done as an industry, was that how interest rate insensitive the US economy in particular has become. How, now most of the debt on corporate balance sheets has been termed out over the last couple of years, is only expiring after 2030. How most of the mortgages are on a fixed rate now, on a 30-year fixed rate. When we look at it, compare that to 2007, 2008, it was almost 40% of mortgages on a floating rate. Now it's less than 10, right? Or look at 1990, you had about 40% of household debt on a floating rate. Now it's 10%. So really, I think the restrictive stance of rates, that to me doesn't count that much. And inflation, if anything, when we look at last week's data, in fact, what it's shown is, yes, we're not out of the woods yet entirely, but I think we do get comfortable with a bit higher than target inflation, which in fact should be helping earnings growth in particular. It should be helping nominal cash flows, and it should be also helping the income distribution in terms of the private household wealth gains that we've seen over the last couple of years, the last 2 years, that has seen the high inflation actually has seen private household wealth really benefit. So there's nothing really particularly negative around that.
Max, let's talk about a part of the equity market where maybe it's not happening. Maybe that story is starting to change, and that's retail. We just heard from Lowe's a moment ago. They've affirmed their outlook. We'll hear from Macy's in just a moment as well. Target coming out before earnings and turning around and reducing prices on 5,000 items and talking about a consumer that's pressured speaks to a loss of pricing power in US retail, Max. Is that just one part of the economy, or is there a broader story starting to emerge there?
I don't think it's a broader story. I think it's one part of the economy, and surely, yes, there are pockets of weakness. Absolutely. There is pockets of weakness among perhaps the lowest income households, the ones that feel the strain the most from higher rates. Absolutely, 100%. But that doesn't mean that it's a broader story. It just means there is more differentiation in the economy. So I keep telling people, look, for 10 years in the 2010s, we've been complaining that everything is a one-way street. Everything is basically just a trade for ETFs and passive investing. And, what happens in the economy doesn't really matter anymore because there is no longer any differentiation because we've got the last buyers, the central banks, active everywhere. That is no longer the case. Now we're starting to see some pockets of weakness on one part of the economy. We're seeing pockets of continued strength. So the growth, the tech companies, that still is showing really, really good signs of strength there. So to me, it just means there's more differentiation. It's a return to the old normal world. It's not really a return to any kind of, is this a sign of a next crisis or next recession break? Absolutely not. It just means there's more differentiation and actually more opportunities for alpha creation.
Which raises this question, Max, because you've been bullish for a while now. And are you less bullish at this point just simply because there has already been such a run-up, a melt-up, as people basically come to the same view that you're putting out there?
Yeah, I think, there will ultimately be some risks, and we do see them perhaps around the Q3, Q4 earnings expectations, particularly in the US, when earnings expectations actually start to pick up a lot for the 493 stocks and away from the Magnificent Seven. So if we don't see any kind of particular broadening out in terms of the economy, in terms of the economic strength, if economic strength is just about fine but not as spectacularly good as we thought, then that earnings growth, those earnings growth expectations, they may be disappointed a bit, but that's only something that I can really play in sort of 4 to 5 months' time. Not really something I can position for right now. Overall, I think it's fairly easy to always say, well, eventually, spreads might widen, or eventually equities go down, or ultimately there'll be a recession. That's totally fine, right? But it's a bit like saying, eventually the sun will be shining in London. We know it's happening, but, it's sort of, who knows? It might take another 6 months, and then it's 2 days and it's over. So, not attaching a timing to something is really sort of chickening out of a view. And to me, if I say, well, eventually, the consumer really might feel the strain too much, and eventually that's going to put us into recession. That's totally fine, but we can't run money like that, right? We can't run money really like that when we say, well, eventually things might be bad. Well, actually, right now, things are still very, very solid. If we look at things like job openings and job postings, for example, labor market strength still ticking along, household wealth creation really good, real wage growth still really good. So overall, things are totally fine.
So, Max, for someone who lives in a place where the sun never shines, you're incredibly optimistic. I will just say, when you're talking about about retail. John was talking about Lowe's. He was talking about this Target price cut. We have seen retail stocks in particular see short interest climb pretty dramatically over the past couple of weeks. There's a sense that consumer discretionary, at least that caters to the middle and lower end, is not going to do well, even as everything else does just fine. Do you adhere to that view? Is that an area that you think is under pressure disproportionately because of the disproportionate pockets of weakness out there?
No, I don't think that. I would actually turn it around, Lisa. I would actually say, you know what? Because there is so much pessimism already, because the short interest is already on such high levels, and because people are already expecting quite some weakness out of that sector, it might actually be now worth to say, well, let's look at some of those consumer stocks. Let's look at some of these consumer discretionary stocks. And in fact, maybe things are not as bad for the consumer as everyone is saying. It's a little bit similar to what people have been saying about Europe and the Eurozone just a couple of months ago, where, you know, you had these relentless downgrades to Eurozone and European growth expectations just now in the last couple of weeks for people to realize, well, it's not particularly great in Europe, but it's not as catastrophic as we thought. And I think perhaps the consumer sector, particularly in the US, is in a similar place where things aren't particularly great, but now increasingly people are sort of really expecting almost a calamity to happen. And unless that really unfolds, which I don't really see any kind of particular signs of that really happening, then, you know, that might actually be a really good buying opportunity now.
So, Max, let's wrap it up. Max overweight high yield credit, overweight US, EM, Japan, underweight DM sovereigns. Are the reasons you're overweight all the rest the reason you're underweight DM sovereigns? Is it the same reason?
Yeah, pretty much. I think within developed market sovereigns, in fact, like a month ago, we've got a little bit more bullish on duration within developed market sovereigns, simply because the valuations are starting to look a lot more enticing and a lot more appealing. But of course, if you are a bit more bullish on duration, if you think that interest rate volatility, bond volatility continues to go down, what that will probably free up is a bit of risk premium in equities. It will allow multiples, equity multiples, particularly in tech, in the growth part of the equity market, to expand. So from a relative perspective, as you know, as good as then perhaps sovereigns will do, actually it's the Nasdaq, it's the tech, it's the growth part of the equity market. It's high yield that you really, really want to own then.
Max, great catching up, buddy. As always, Max Kettner there of HSBC. I guess with something to say back to Marko Kolanovic over at JP Morgan, who is still incredibly bearish on this equity market. Equity futures right now on the S&P 500, stable and just about unchanged after closing yesterday, just short of all-time highs. Let's give you an update on stories elsewhere this morning. Let's get to your Bloomberg brief and starting with this story right here. Donald Trump is closing the gap in fundraising with President Biden. Trump outraised Biden and the Democratic Party by 25 million in April, pulling it a total of 76. The boost comes on the heels of several high-profile fundraisers, including a Palm Beach event hosted by billionaire John Paulson. Overall, President Biden's campaign still holds a wide cash lead over Trump's. Martin Gruenberg is stepping down as head of the FDIC after findings that the regulator was a toxic workplace. Gruenberg faced mounting pressure following a scathing report that detailed allegations of harassment and discrimination during his tenure. The accounts came from a months-long probe into a Wall Street Journal article about female bank examiners facing a sexualized boys' club environment. The White House said it will move quickly to nominate a successor. And finally, Jamie Dimon says succession plans are, quote, well on the way at JP Morgan Chase. Speaking at the company's Investor Day, Dimon telling shareholders senior individuals at the bank are being prepared for his eventual departure. 68-year-old Dimon adding that the timeline for his retirement is not 5 years anymore, making reference to a long-standing tradition of saying his retirement is 5 years away, no matter when asked, no matter who asked him. So we all stopped asking him, Bramo, and now we get a different answer from the man himself.
At a time when they've rearranged some of the management in terms of Mariana Lake, as well as Dan Pinto and a whole host of others that have been elevated to the top ranks. Just sort of interesting. He said, when I'm not ready to wear the jersey anymore, put it on every day, get on the field, I'm not gonna.
Exactly. He still says he has the energy to do it, even though he's saying it's not 5 years anymore. The timetable looks like it's going to be a little bit less, but he's saying he still has the energy to do it. So kind of conflicting.
I hope I have the same energy in my late 60s that I have now. I struggle to believe that I will.
That's what I was going to say about myself. Yeah, I know.
But I hope I will. Up next on the programme, reviving the PC-Mac rivalry.
In the late 80s and the early 90s, when we all fell in love with PCs, That was what really got us going, which is the ability to use computers to create. And I think this AI is just going to take it to the next level.
That conversation just around the corner, live from New York City this morning. Good morning. Live from New York City, welcome to the programme. Equity futures on the S&P 500 just about unchanged here. In the bond market, yield to lower by 2 basis points on a 10-year, 4.4218. Under surveillance this morning, reviving the PC-Mac rivalry.
I think if you think about the PC, it has always been about, creating things, right? That's what you sort of do on a PC. AI is an assistant. AI helps you as an end user do anything. In the late 80s and the early 90s, when we all fell in love with PCs, that was what really got us going, which is the ability to use computers to create. And I think this AI is just going to take it to the next level.
So here's the latest. Microsoft introducing a new category of AI-focused PCs, stepping up competition with the likes of Apple and Google. The company saying the machines will be more than 50% faster than Apple's top-of-the-line MacBook Air, thanks to a special chip dedicated to AI processing. Mandeep Singh of Bloomberg Intelligence joined us now for more. So I'll use his words, Mandeep. Are we about to fall in love with PCs all over again?
Well, every device maker right now is thinking about a refresh cycle that they want to see. And look, in this case, PCs, we spend a lot of time, probably not as much as we do on our smartphones, but clearly, from a productivity perspective, it is a big use case for AI. And you can see the argument why the refresh cycle would be pulled forward if we had the functionality and the chips to facilitate that. I just doubt that there will be as much, to offer as, the CEOs were talking about yesterday, given we are still at a very early stage where the infrastructure is not even built out. How can it translate into, the devices that we use on a day-to-day basis? So,
could you detail the potential functionality? What would the user experience look like? What would it be like?
So, I go back to what you can do on the smartphone. So on the smartphone, there are so many things you want to interact with, without having to go across apps. It's the same thing on desktop. You don't want to go between programs to, copy paste things. What if there was a smoother way to pass information from one app to the other, where AI can actually facilitate? And this goes back to the point everyone makes about workflows. Workflows will improve as a result of, generative AI and the fact that we have these co-pilots and assistants. It's just vendors don't work so well with each other. At least that's what we have seen over the years. These companies want to develop their walled gardens. They don't want to share data. And that's the promise of AI, is if it had the perfect information, it can automate a lot of workflows. I just don't see that happening that quickly.
Workflow efficiency isn't very sexy. I'm sorry, it is to a lot of people who are looking to reduce costs, but for just an average person who's buying a phone, a smartphone, it isn't necessarily going to be a way to say, yeah, I want to make my workflow more efficient when I call my kids. So at what point does that generate a real super cycle in terms of replacing phones, especially given they're probably going to be a lot more expensive?
What we have seen in prior cycles is the killer app always comes much later. So you develop the infrastructure, you have, a lot of promise in terms of, think of what smartphones did. The apps that were based on location-based awareness came in much later, in 2009-10, when the smartphones were there in 2005. So it took good 3-4 years to figure that out. I think it will be the same. Right now, we are in that infrastructure build-out phase where everyone sees the promise of generative AI because you can ingest a large amount of data, you can be multimodal in the sense that you can pass video, audio, and all the other kinds of stuff. The system can interpret it. The question is, how do you filter out the noise and actually drive productivity than a human doing it? And that's where it will take a while to figure that part out.
When it comes to Microsoft and their laptops, the issue they probably have is the fact that everyone uses iPhones, and you want to be in the same ecosystem. Isn't that the leg up Apple has?
It does, and it comes down to distribution. So whoever has the best distribution, whether it's Google on the search side, operating system side, or Apple in terms of the devices, it's very hard to move things away from their ecosystem because AI, in the end, will be commoditized to the extent that everyone has the same infrastructure. They have some form of large language model, which is what we want to hear from Apple. And then the AI features will be similar. I doubt it will be so highly differentiated where the AI on Apple or Google will work far superior than others. But it's just the seamlessness of how you deal with AI and how it's incorporated on your devices.
Mandeep, we can't talk about AI without talking about chips. Yesterday, we heard from the NVIDIA CEO speaking to Ed Ludlow, saying the technology industry depends heavily on Taiwan and will continue to do so for the next foreseeable time. And then we have overnight a Bloomberg scoop about ASML and TSMC saying basically they can disable all of their manufacturing remotely if China were to invade Taiwan. How important are these geopolitical conversations to these technology companies right now?
I mean, right now, when I look at NVIDIA, the biggest risk going into the quarter is the fact that, the China revenue, again, could completely go away. It's the same risk for Apple. Apple seems to be maneuvering it well, but in the end, these companies are dependent on China for revenue and to an extent on the supply chains. I mean, think of Apple. They still have 90% of the assembly being done in that region. NVIDIA doesn't have that kind of exposure on the assembly side, but it still relies on some parts of the supply chain in that region. So the geopolitical conflicts clearly are creating the tensions, but these companies seem to be maneuvering it quite well, at least so far.
How long do you think we'll have to wait for these supply stories to change? This is about a kill switch. So they can kill production, but the production still needs to come from somewhere. Where's that supply going to come from?
Well, so we know these companies are looking into other pockets of Southeast Asia, whether it's Vietnam or moving to some other parts, even India. And look, that's where you have to be pragmatic. Not every region will have the capacity to take, advanced manufacturing or advanced assembly. And this will take years. Think of how long it's taking to open an advanced manufacturing fab here. Despite passing the CHIPS Act, despite giving the subsidies, it's going to be 3 years before we see that fab online. So that's what we are talking about in terms of timeline. These things take a while to play out.
Mandy, before we let you go, the why behind why it's so complicated to have some of these factories isn't just the technology to build the chips. It's also the idea of the expertise that you need. And Taiwan's entire infrastructure is built around that. What are we doing here to try to support some of the factories that we have?
I mean, training is a big aspect of how you are going to bring those fabs online. And yes, you need the personnel. Immigration probably is going to be a hot button issue in terms of bringing the talent to work in those fabs. But clearly, I think, again, these things will take 4 to 5 years before you see real progress. And we are talking about more cutting edge stuff. The 2 nanometer, 3 nanometer, you just can't jump to 4 or 5 nodes overnight. That's what we have figured out with Intel. Intel wanted to do 5 nodes in 3 years. Well, they couldn't execute. So there's a reason for that. It takes a lot of gradual progress to get to a point where you can show, okay, now we can do this onshore.
Drum roll. Big story tomorrow afternoon. You know what it is. NVIDIA. We've had price target upgrades from Barclays and Stifel in the last 24 hours, north of 1K. How high is the bar for NVIDIA this time around?
I mean, I feel like they're priced for perfection every quarter.
And then it's beat and raise.
And beat and raise. But look, I look at where the good news is going to come from. Right now, every CapEx spender, the hyperscaler, has raised their forecast for next year. So I look at where the incremental positive news is going to come from for NVIDIA estimates to go up. And that's where I feel, OpenAI didn't launch GPT-5. That's a negative. Because when you think about it, if the LLM companies are consolidating, it's going to make it hard for NVIDIA to find that next incremental buyer. Maybe it's Tesla. Tesla talked about a $10 billion with Oracle. But I feel the rate of positive improvement is going to slow down because if they're losing China revenue, if all the hyperscalers have already announced their plan, it's baked in the price.
I have no doubt we'll be catching up with you tomorrow quite a few times on Bloomberg TV. Mandeep Singh, thank you, sir, of Bloomberg Intelligence, going into that big earnings report tomorrow afternoon. For how much longer can that company keep beating and raising, beating and raising? Coming up next, we'll catch up with Stephen Cook of CFR on the death of Iran's president and tensions in the Middle East. That conversation just around the corner. Equity futures on the S&P 500 just about unchanged after the S&P closed yesterday, just short of all-time highs. Two-day winning streak in the equity market coming into Tuesday. Your S&P 500 looks a little something like this. Equity futures totally unchanged after closing just short of record highs yesterday on the S&P. We closed at all-time highs on the Nasdaq 100. It's been quite a run. Nvidia helping out, going into earnings tomorrow afternoon. That is the main event of the week, at least the main event on the schedule. In the bond market, treasuries, 10-year yields climbing for 3 days, which goes against the grain of the last month or so. This morning, we snapped that trend. We're down another 2 basis points or so. 442.37 on a US 10-year. On a 2-year, down about 2 basis points as well. 482.64. Plenty of Fed speak, all singing the same song. The lyrics haven't changed. You know the lyrics. We've got to wait. We've got to wait, and we're not going to hike. Is that enough? You'll get more Fed speak a little bit later. Turn to foreign exchange. You want to finish on the euro. You'll get some ECB speak tomorrow from ECB President Christine Lagarde. Euro dollar at the moment 108.70. We're positive by 0.1%. I think we all know they want to cut in June. It's about what they want to do beyond June and maybe even in July. Look out for that conversation tomorrow with Christine Lagarde. Our top stories today under surveillance this morning. JP Morgan CEO Dimon saying the timetable is not 5 years anymore, but the decision on a replacement is in the way, but not at current prices. So 2 stories to deal with here, Lisa. Let's start with Succession. 5 years, 5 years, 5 years. It's not going to be 5 years anymore.
Be a reason to exit. He has shut down that possibility of that job being in Washington, D.C. However, the speculation continues to rage.
He also, though, has said in the past that he would do anything to help his country. Does that mean actually make...
Think about Marianne Lake. We're talking mid-50s. So that's kind of sort of like prime age you'd think to take over as a bank CEO and get involved in the leadership at the top of this company. This has been going on for ages. It's about time we get a conclusion, isn't it?
You could say that 5 years ago and 5 years before. The thing is, to me, how do you build up the profile of someone when Jamie Dimon is synonymous at this point with JP Morgan? You mentioned the share buybacks. I found that more interesting also, given the fact that it's not the best use of cash. Well, those shares are up, 20% so far this year, which, again, makes sense that people are saying, well, if they don't want to buy their own shares, neither do we, because at what point do we see upside?
We're up almost 20% year to date, then dropped about 5% yesterday. We're positive 15% year to date. Sales for the first quarter coming in better than estimated. More retail earnings on the way. We'll get Macy's a little bit later this morning. Target results coming tomorrow weekend. This is not what you do if you have pricing power and a lot of footfall.
Well said, especially because Lowe's, they had better than expected comparable earnings. The why behind it, again, speaks to that same story. This idea that a lot of people are doing small-scale repairs rather than these sort of large-scale overhauls of their homes because they don't want to have to spend all that money. Again, even though they saw a beat there, it's the why, the cost consciousness of consumers that gets my attention.
For me, this speaks to cracks in the consumers, and it lines up with the consumer sentiment we saw from the Michigan survey, which we'll get another read on Friday, but also the New York Fed report, which shows that Americans are very concerned about potentially the uptick and the direction of inflation.
It's happening. Slowly. We'll see if we get more of it a little bit later. Macy's earnings just around a helicopter crash. Speculation growing as to what the events mean for Iran and the Middle East. Stephen Cook of CFR saying this: it is clear that some significant portion imagine a new round of protests against the regime. Stephen joins us now for more. Steve, can you walk us through what kind of internal power struggle we should expect domestically in Iran over the next month?
It's a great question. Ibrahim Raisi, who himself is not well. So Iran is looking at potentially 2 short lists to succeed Khamenei, which is at the top of this regime, where the Islamic Revolutionary Guard Corps is making a bid to essentially take the whole thing over. There's likely to be a very significant power struggle. While that power struggle is going on, there are, as I said, significant numbers of people who are pleased with Raisi's death, their desire to overthrow this regime. This is not an unheard of thing in Iran. Iran has been roiled by large demonstrations over the better part of the last 5 or 6 years. So it is a very, very expect that there'll be much change, though, on the foreign policy front.
But the fact of the matter is, this could be very controversial for a country that overthrew a monarch. Where does that leave, you think, Khamenei's thinking about that?
Yeah, the most talked about, the founder of the Islamic Republic, Ayatollah Khomeini, had said, which was that there should not be a hereditary leadership in Iran. Yet Mojtaba has been put in the position where he is a likely successor. There's one other identified possible competitor to him, which is a guy named Ali Reza Arafi, who is the leader of all seminaries in Iran. But eyes are all on such a religious leader that he wouldn't go against Khomeini invading his son if that, in fact, is what happens.
Stephen, I wanted to get your sense on what did you make of the U.S. response to Raisi's death. Yesterday at the United Nations, instead of walking out, which at one time historically in the U.S. past would have happened, the U.S. representative stood in silence. What do you make of the U.S.'s response?
There's no other word for it other than bizarre, maybe perhaps even stunning. Ebrahim Raisi is known as the Butcher of Tehran. In the late 1980s, he signed the death warrants of 5,000 people. This is someone who has American blood, Israeli blood, Arab blood, Iranian blood on his hands. And the statements of condolence coming in from it was, we stand with the Iranian people during this period of transition, end of story. Yet standing at the United Nations, issuing a statement.
What does that say about U.S. policy writ large when it comes to Iran?
Well, I think it demonstrates that at least within the bureaucracy, there remains this idea that the United States can forge a new relationship with Iran. The problem pushed the United States out of the Middle East by sowing as much chaos. Gaza, Israel's northern border, the Red Sea, Iraq, and Syria. So the idea that if we're just nice enough to the Iranians, with a little bit more diplomacy, with some...
The president's death in Iran actually speaks to maybe a certain efficacy of some of the sanctions if they didn't have the parts or the supplies to upgrade helicopters that largely ended, I think, production in 1968. So is that sort of evidence to you that maybe some of these sanctions are working?
Well, in fact, the former Iranian foreign minister, Javad Zarif, said the same thing as Halima, that it is difficult to source parts, particularly in the aviation sector. And it is perhaps an indication that the faulty equipment was to blame for this accident. Of course, it was terrible weather. We know nothing about pilot training, but certainly the Iranians are suffering under sanctions.
Meanwhile, there's been a lot of speculation about what this means in a broader sort of geopolitical stance. And the resolution that a lot of people have come to is not much unless there is some sort of finger pointing outside of Iran or even within Iran in terms of some malfeasance on some level. Do you agree with that? Or do you think that this does have implications about either Iranian and Israeli tensions or some of the factions that are sponsored by Iran and what that means for the hot war in the region?
Well, I think there's likely to be lots of conspiracies about the role of Israelis in this accident. Israel and Azerbaijan, from where Ebrahim Raisi was coming, have very close relations. Of course, the Iranian military has announced an investigation into the crash, which would suggest that they're not finger pointing just yet and not looking for an escalation at this very, very sensitive time.
Stephen, I just want to finish on the conversation you were having with Anne-Marie. It wasn't that moment of silence. It was the statement from the State Department, because you can apologise for the moment of silence and say it was a mistake. The statement by the State Department is deliberate. Someone's written it, someone's copy edited it, someone hit publish, they didn't retract it. Stephen, I wonder, when you publish stuff like that, what degree of influence can you expect to have over countries like Israel when you fail to demonstrate that their enemy isn't yours?
Yeah, I think that this is something that is a problem in American foreign policy in recent years. Not only the Israelis, but the Saudis, the Emiratis, the Bahrainis feel that the United States has bent over backwards to forge a new relationship with the Iranian, and that has essentially let them hang out to dry. And that's why you see these countries, particularly the Saudis and the Emiratis and others, hedging with America's global competitors, notably the Chinese, because they just don't believe it when the United States, we stand with you for stability and security in the region, yet the United States is reaching out to the Iranians. And this statement of condolence is, I think, something else that the Saudis, Emiratis, Israelis, and others will be able to point to in their bill of particulars against the United States.
Stephen Cook, thank you, sir. Stephen Cook there of CFR on the latest in the Middle East. A bizarre 24 hours from the US side.
We have the transcript of the reporters that questioned Matthew Miller, the spokesman for the State Department. And the reporter was saying, if you really think Raisi was as bad as he was, why did you put out this statement? And this is what Matthew Miller had to say. As long as we're addressing the historical record, the United States offered condolences when Chavez died and when Joseph Stalin died, people with whom we had great disagreements with. So that is the historical perspective the State Department is attempting to spin this statement, which the Biden administration is getting a tremendous amount of criticism about.
A very strange 24 hours. If you are just joining us, welcome to the programme. Equity futures right now on the S&P just about unchanged. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. First story, there's just one big bear left on Wall Street. After Morgan Stanley's Mike Wilson capitulated, JP Morgan's Marko Kolanovic holding firm in his gloomy outlook on the equity market, urging clients not to buy stocks, while acknowledging his outlook has hurt portfolio performance. Kolanovic citing a number of reasons, including high valuations, high rates, and elevated inflation. JP Morgan has the lowest year-end target for the S&P, 4,200. The index this year for 24 is up 11%. Elsewhere, shares of Palo Alto Networks are trading lower in the pre-market. The company's third quarter earnings beat estimates, but it offered a downbeat forecast for the current period. The tepid outlook follows a disappointing report in February when Palo Alto Networks, their shares suffered their worst single-day drop ever. At the time, the company's CEO said customers were facing, quote, spending fatigue in cybersecurity. And the weirdest story of the last day or so, this one right here. On the brink of creepy. In fact, it is creepy. Actress Scarlett Johansson said she was, quote, forced to hire legal counsel in order to remove an AI voice from OpenAI's latest chatbot feature that closely resembled hers. The AI voice known as Sky was part of the latest update to ChatGPT and has since been replaced. In a statement, the Hollywood actress revealed that she received an offer from Sam Altman to use her voice in an audio feature, but had declined the project. And then friends and family started to hear a voice that sounded a lot like hers.
Yeah, it's weird because they went to her, she said no, and then she had to hire legal counsel because it sounds, what they're saying, quote, eerily similar to her voice.
It's a creepy. Bottom line.
Well, and it frankly underscores the creepiness of the whole endeavor. I mean, it's exactly not the look that they want at a time when people are wondering about intellectual property, including your voice.
If ScarJo wants to come on and talk about this, I think you're keen, right? You'd like to hear?
I'm keen. I caught up with
Anne-Marie
her at the
would like
White
to hear
House
from you.
Correspondents' Dinner, so I think she would come on.
She failed to mention the story?
She did not. We did not talk about
Okay,
AI.
we'll look for an update a little bit later this morning. Up next on the programme, Fed Speak, Overload.
We'll need to be patient and let restrictive policy do its work.
We probably need to sit here for a while longer.
It's too soon to tell what path inflation's on.
That conversation coming up next, live from New York. This is Bloomberg. From New York, welcome to the programme. Equity futures on the S&P 500 just about unchanged. Yields coming in after pushing higher over the previous 3 days. We're down by about 2 basis points on a 10-year, 4.4257. Under surveillance this morning, Fed Speak, Overload.
We'll need to be patient and let restrictive policy do its work.
We probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
It is appropriate that we maintain the policy rate in restrictive territory.
It's too soon to tell what path inflation's on, so we just need to collect more information.
I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
We'll get there, eventually. That's the latest. If that wasn't enough for you, there's more to come. Barkin, Waller, Williams, Bostic, Barr, Collins and Mester all on deck and set to speak today. Former Fed economist Claudia Sahm saying this: there's clearly an overload of communication policy. There is. But on what matters, the rate path, we won't learn anything new. Claudia joins us now for more. Claudia, wonderful to catch up with you to get your perspective from inside the Federal Reserve and out. Can we start with this? Why do you think they're failing to entertain the conversation that a lot of people on Wall Street would like to hear about? And that's the neutral rate, where it is if we're going to normalise just what is normal in this regime.
Frankly, I doubt they agree on what the neutral rate is. I mean, they're very firm that where the Fed funds rate right now is above the neutral rate. I mean, they can't even give us a definition of what confident is, and that's data driven, right? The neutral rate, something very hard to get a handle on. So it's just not to them, I think, a relevant conversation.
What do you think confident is?
I think they need 3 months of good data before they're even going to start thinking about being confident. The Fed has gotten really box himself into a corner by being hyper data driven. And that's really unfortunate for the way monetary policy works. And so at the end of the day, your statistical agencies like the Bureau of Labor Statistics, they're more or less an influential member of the Federal Open Market Committee. It's not how this is supposed to work.
This is something you've said before, that this economy doesn't complicate the Fed's inflation fight. It's not a reason for the bank to delay rate cuts either. Claudia, for people who aren't familiar with that perspective of yours, could you share it again? Why do you see it as a problem that they're waiting so long?
The Fed is putting pressure on the economy, more pressure than frankly is needed to get inflation down. We have seen since the very beginning of this that COVID created disruptions in the economy that showed up in inflation, showed up in a lot of different ways. The economy was not working as normal. We're getting further from that initial impact. Things are getting better. The Fed, if it gets in the way of this and pushes too hard, then we end up in a recession, which is not necessary. It will be a huge unforced policy error.
Claudia, every single note that I've been seeing from Wall Street analysts actually has the opposite fear, that actually the bigger risk right now is a reacceleration of inflation and that this is not a very restrictive policy. That, yes, you are seeing pockets of weakness and there is undue kind of restraint on particularly lower and middle income families, but otherwise you're not seeing it. Where are you seeing it on a broader economic level that actually can bring inflation down?
So where is this acceleration coming from, right? It's not just looking at the top line numbers. You have to tell a story about what is forcing, what would force that kind of an acceleration. We've seen the labor market moderate. We have signs of solid and yet not as strong consumer spending numbers, right? Like you have to have some event that's pushing the inflation, pushing the demand, because the Fed can only work on the demand. And we've got some categories of spending that can be tied directly to problems we had earlier in COVID that are still pushing up inflation. That's not about demand right now. Owner's equivalent rent was pushed up well over a year ago. The Fed cannot bring that down by high interest rates. It is the passage of time working through that system that really brings inflation back down into a cutting space. And we know that's coming.
Which is the reason why maybe some people probably agree with you on the Fed, maybe even Fed Chair Jay Powell. And you have others who are a lot less certain with respect to just whether it's going to take time. Loretta Mester, speaking to our own Michael McKee yesterday, did say something concrete, which is that she is revising her call for 3 rate cuts this year. She no longer sees that as appropriate. Do you agree with her that essentially, even if you think that the Fed has the leeway to cut rates, not nearly as much as they had earlier and really only 1 or 2?
I absolutely understand why Mester's saying that, right? The Fed is very cautious. They got burned in 2021. And as an institution, they're not going to get out there and do something that's more aggressive in terms of cutting. Essentially, the last 2 days, you've heard a lot of talking dots, right? We've heard a lot of people in terms of what they're doing with their forecasts, a summary of economic projections. A fun twist to this is we get the next consumer price index reading on the second day of the FOMC meeting. Right. So we need that data. We need to know more. I fully expect the median cuts to move to 2. I think just the math works out that way.
You've had a lot of talking dots, Claudia. That is a fantastic statement. I plan on using that because that actually is what we're looking for. You talk about how we get a lot of Fed speak, but not a lot of actual news that we can use. What are you looking for? What could they say, given the fact that we heard Raphael Bostic come out and basically said, we're human. This is life. We get uncertainty, and that's part of the whole reality of this kind of transitional moment that we're in.
I don't want to hear from them. I want the next CPI release, the one after that. I want to see the labor market. I mean, honestly, that's what they're filtering. What we've heard in the last 2 days is a multitude of ways to say we're not confident. We need more data. It makes sense. Like, I completely follow. They're being responsible. They're being predictable in what they're doing. But honestly, they're just saying the same thing over and over again.
Claudia, we also want the next CPI release. Your note, you talk about inflation expectations in early May were, quote, much ado about nothing. But then we have Target overnight cutting prices. Do you see this deterioration in the consumer?
I don't see it. We have seen a moderation. And this is why it is dangerous to some extent for the Fed to wait so long, because we are not the economy of last year in terms of really firing on all cylinders. So things are moderating. The risks, there are more risks to the downside on the labor market in particular. I think you do see signs of consumers faltering, but they're not, those are risk case. We don't see them in the baseline. But the labor market, it's not pointed in the best direction. So things could go south. They don't need to, but they could.
Just a flag on the consumer, waiting for Macy's earnings. Those numbers should drop in the next 60 seconds or so. Tomorrow, we'll get some Fed minutes. Claudia, can we talk about the Fed minutes just briefly? How much distance do you think there is between the chairman and the rest of the committee based on some of the communication we get from him, particularly over the last few weeks?
Jay Powell, as the Fed chair, speaks for the FOMC. He can't speak for every single member. They clearly have some disagreements. It's healthy to have disagreements at this point. But he will reflect, the minutes will reflect what Powell said at the last press conference. They will reflect, if you kind of collected all the verbal dots of the last few days, it would kind of look like the median, maybe a little bit more upbeat because we did get a good CPI since last FOMC meeting. But I mean, Powell's the Fed chair. He can't go rogue here. Right? Like, he is communicating for the FOMC. It's clear he thinks we're headed towards 2%, not confident, but like that's the direction. So I don't expect the minutes to really sound any different than the Fed speak we're getting right now. And yet the tone is probably going to be a little darker than it would be if, the meeting were after the last CPI.
True. Claudia, thank you. Appreciate your time, as always. Claudia Sahm there of Sahm Consulting, breaking things down for you. Just breaking down numbers from Macy's, just drop in right now. The outlook, full-year adjusted EPS 255 to 290. That's the new range. The previous range, Bramo, 245 to 285.
So basically coming in slightly above. What I find interesting is that the full-year net sales projection is about in line with where it was before, a little bit higher. So earnings actually coming in higher than maybe some of the sales expectations point to. So margins aren't compressing as much as we would expect. That, to me, is interesting.
Just a little bit lower than expected on margins for the first quarter. Macy's is down by about 2% in the pre-market. Much more still to come on a retail story in America, and we'll be catching up with JP Morgan's Jack Caffrey, Bloomberg's Alex Webb, Israeli Minister of Strategic Affairs Ron Dermer, and Chuck Grom of Gordon Haskett. All of that still to come from New York City. This is Bloomberg.
This is a Fed that has sort of a cutting bias to it.
Our view is that the Fed can cut. That's our economist baseline call.
For this Fed, June is probably not in play. The whole idea of either July or December, but certainly December.
You don't need an interest rate cut. What's an interest rate cut going to do to validate your overweight to stocks and bonds?
It has to go exactly right in order for the Fed to cut. But at this point, they're kind of caught in a box.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the second hour of Bloomberg Surveillance begins right now. From New York, good morning, good morning. Quite a 24 hours for the retailers. Listen to this commentary, raising the outlook over at Macy's, but this line jumps out. The outlook assumes customers will continue to be discerning in their discretionary purchases. We heard a similar thing yesterday from Target. Going into numbers from them tomorrow when they said this, we know consumers are feeling pressured. Lisa, that led them to cut and reduce prices on 5,000 items into Memorial Day weekend.
So here's the sort of distinction that's very difficult for me to really fully understand, and frankly for Wall Street, which is, does this represent weakness in the consumer or just simply discretion, simply being a little bit more prudent about what they buy and which areas they buy? Because it looks like sales are coming in stronger than expected, even if there is this caution out there.
Also, the bifurcation of the consumer. What stood out to me for Macy's is that Bloomingdale's rose 0.8%. Macy's flagship fell 1.6%. Where was the standout? Bluemercury up 4.3%. This is a very expensive, I call it almost luxury Sephora, and it's for beauty junkies. Very expensive candles, skincare. That's where they're seeing some growth.
That's who has the money. And I think all of this speaks to the theme of the last week or so in this program. You can identify weakening, but things aren't weak. Slowing, but we're not slow. How many times we heard guests around this table use those exact words? And this is the struggle for the Federal Reserve to get a read on these things. Is it something they need to worry about? Is it a welcome cooling or an unwelcome deterioration? Just a moment ago, we caught up with Claudia Sahm, and she called the Federal Reserve officials speaking dots, verbal dots, was that right? Verbal dots of the FOMC. You're going to get a few more verbal dots speaking a little bit later. Barkin, Waller, Williams, Bostic, Barr. I think Goolsbee tomorrow. You get some minutes as well. This is going to go on and on all week. The one to watch has got to be Governor Waller.
She said, you've had a lot of talking dots. And I said, well, what do you want to hear from them? She said, I don't. They're all saying the same thing. Just stop. This, to me, is sort of the issue, that the market has moved on from the Fed. At what point do we see real response in the market to Fed projections? Because right now, they're saying, as Claudia Sahm indicated, a lot of ways to say they don't have confidence yet. What will give them that confidence? They won't even entertain that idea. So it gives people sort of this question of, what are we even listening for?
Well, Jonathan, you tried to get Claudia to really define what confidence means, because we continuously hear it out of Fed officials, and she said 3 months. 3 months of data, that would be confidence for this Fed.
Was last week 1 month? Is that the first month?
I think so.
So 2 more months. And then she talked about June 12th. June 12th's the big one, isn't it? June 12th's a massive month, a massive day. You get the release of the CPI print in the morning at 8:30 Eastern time. Then later on that afternoon, get a Federal Reserve decision and a bunch of projections as well. So that's going to be a really important meeting, really important event in a couple of weeks' time. Equity futures right now, here are your scores on the S&P 500, just about positive by 0.02%. In the bond market, yields are lower by 2 basis points on a 10-year 4.4237. In foreign exchange, the euro just a little stronger by 0.1% at 108.67. Coming up this hour, we'll catch up with Jack Caffrey of JP Morgan Asset Management on equities hitting all-time highs. Chuck Grom of Gordon Haskett reacting to Macy's earnings, and Israel's Strategic Affairs Minister Ron Dermer as Netanyahu faces allegations of war crimes. We begin with our top story, all-time highs on the Nasdaq ahead of this week's main event, Nvidia earnings tomorrow. Jack Caffrey of JP Morgan Asset Management writing this: stocks are looking overbought in the short term. When I look at some of the broader technical measures, investors are willing to look for the next ways to access the importance of AI for their portfolios and the potential to create growth where there was little growth before. Jack is with us around the table. Jack, good morning. You are bullish, but it sounds like there's a question mark now, where there wasn't a question mark before.
I mean, year to date, we're up 12%. So we've had a very, very good year. We're up 5% in 5 weeks as we went through earnings. And I do think you have a little bit of a disconnect to some of what we were talking about. Earnings supported the most recent move. And I think equity investors have heard the Fed start talking about maybe we don't have to be as cautious and as frequently beating the drum for the possibility of another rate move higher. And yet, economic surprises have turned very negative in the shorter term, and I think that's what the bond market has been looking to in terms of embracing their sense of maybe we're finally going to get the slowdown we've called for. So put that with a VIX of 13, and you wind up with two markets hearing two very different messages and an ability to say that top might be slowing a little bit from spinning so aggressively that you could knock it off its axis without very little news or very little pressure.
And that's what we're vulnerable to going through the summer. There was one further thing you identified as well, and we revealed it in that quote we started with the conversation with. The second derivative AI plays.
Sure.
Utilities, things like that. Do you think that's evidence of investors reaching just a little bit too much?
I think it's people trying to say we have played this AI theme in its most obvious beneficiaries of the semiconductor producers of the graphic processing units, the GPUs and TPUs. And so now you're saying, well, what's next? Because you still haven't made a lot of cases for the actual implementation of AI generating revenues. So I think people are still coming back to how can I try to find picks and shovels? So utilities have become a growth sector for the first time since we rolled out air conditioning in the 50s and 60s. Interesting little outcome with that. But I think when you consider that, utilities are regulated. So their CapEx will take a long time. It's not like you can just go to the board. You have to go to your regulators. You then have to borrow money in order to build these things. And then you're capped on what your profitability looks like. Very consistent, very wonderful. But you're left with, is this really an AI play? Or is this just I need something that might be growing in a market where I'm a little less concerned? You see technology investors buying electrical equipment stocks and valuing them like they're semiconductor names. Like, maybe, but maybe that order book takes a little bit longer to become actual revenues. So it does feel like people are stretching a little bit in the short term.
But everyone's shovel ready. No, I'm kidding. I'm curious, though, going forward about what this means in terms of, do you just stay away from utilities and the like, or does this sort of tell you maybe people feel like the big tech names are a little overplayed and that, frankly, they don't have that much more room to run?
Well, I think parts of tech look very expensive. And I think, where I have to admit that I occasionally dabble in the dark arts of technicals, you wind up looking at sort of the technology, the semiconductors and the softwares are not in market leadership. You wind up seeing things like pharmaceuticals in leadership. That's certainly a defensive position, absent obesity, which seemingly is still a growth vehicle. So I think people are trying to be a little bit more nuanced. I think people are trying to look for growth where it might not have been. And that all said, when you have 25, 30% of the market not really behaving as well as it has for the prior 6 months, I think it forces a little bit of a pause.
You're not necessarily bearish. You're just not as bullish as you were, say, a couple months ago. Is that correct?
I'm naturally a bull, but right now I have to say maybe I need to pause a little bit before venturing out of my cave.
What's the signal from some of the...
I mixed my metaphor there, sorry.
It's okay. I do it all the time. What's the signal from some of the retailers that are coming out right now and that are portraying a weakening consumer, a discretionary consumer, but not one that's really run out of spending power?
Well, let's go back to parse the difference between discretionary and staples. And to some extent, the high end is doing well, which makes sense. We've got market at all-time highs. So it's easier to go and buy expensive skincare products in that world at Bluemercury. It gets harder. Bloomingdale's doing well. That's doing well. And your more middle market consumer who's been facing tax increases at the gas pump on a weekly basis. As oil prices moved higher, gasoline is moving higher. You're going into driving season, maybe at the margin. With this drumbeat of weaker consumer confidence, it's a little harder to actually spend that extra dollar. And so retailers have just worked their way through a lot of inventory, and I think they're scared that they get caught holding the bag again.
Are commodities one of the reasons why you talk about fuel costs, one of the reasons why you're a little bit pausing before you come out of your bullish cave?
I think fuel is certainly out there. If you come back, and I'll again dabble in the dark arts for a second, why are transportation stocks so weak? And if to the extent we actually rely on truck companies to actually move product from point A to point B, what is that weakness suggesting if you go back to the very earliest of the technical indicators, the Dow theory? You're supposed to have transportation confirming the move in the market. Right now it feels like they're sending two very different signals, unless basically all transportation has been absorbed into Amazon and they're the only shipping company that matters.
So what have you been doing? What have you been selling? Have you been selling anything? Have you been de-risking? And if so, how?
I sit there and suggest that I'm a little bit cautious in the short term, but I'm running with relatively low cash overall. Call that, just over 1.5% within portfolios. So, I'm committed if you go from that perspective. I have been easing into a bank over time in the shorter term. And I think that comes back to a sense of, the consumer remains employed, they are getting paid, and it doesn't feel like we have the worry that works its way through the credit markets that we've been hearing about for years and years and years. And from that, you actually get paid very attractive dividends, I think, in many of the bank stocks relative to other places in the market.
Could you describe a bank, the type of bank you'd like to invest in, given that I know you can't name the bank?
Well, I can't name a specific bank, but I generally like to find banks that have fee income to go.
Being as cryptic as you are.
It's not that cryptic. Carry on.
I like having a job. It's very important to me. And to the economy overall.
I'm not going to put too much pressure on you. Just tell me a little bit about what the business looks like.
When I'm thinking about banks, I'm trying to think about places where I see people moving and where I think that we actually are reindustrializing America. So you could read that in terms of, at the margin, I'd rather switch away from banks that serve where people are leaving towards banks where people are actually migrating to, where business are being created. In general, if I can also get that bank that isn't completely reliant on lending, but actually can get some fee income to go along for the way, generally high returns on capital, generally taking a little bit less risk thanks to Basel III Endgame, I think that winds up making for a more attractive package overall.
So, Jack, you're in your bullish cave. I'm in my bearish cave because that's where I live. But I'm wondering whether you could see something in the near term that can make you feel a lot less willing to be in the cave anymore, wanting to be out and be more aggressive.
I think in the shorter term, the challenge we have is corporate earnings are over. And so we're not going to get any real updates out of companies in terms of how they think they get through the back half of this year, when we are expecting something that looks like a hockey stick when you start looking through the earnings picture. So how do we get a little bit more confidence with that? And that's where I come back to looking at economic surprises. That's the data we get every day that should make us more or less confident in what companies have offered in terms of what they're going to tell me on one day for 1 minute, 90 days from now. So it's that economic surprises. Are initial claims getting better or worse? Are we seeing, 220 becomes 240? That's bad. 220 goes to 210. All right, we're still in this muddle. And muddling is not what the Fed wants. I think the Fed wants alacrity of a decision one way or the other so they can get off the pot and move forward with some of their policy moves that people keep telling them that they're going to engage in. You know, 1 rate cut, I'm still an inverted curve. 2 rate cuts, still a very inverted curve, 3 months, 10 years. How do I get 4 rate cuts of 25 basis points to get to a curve that's flat, assuming the 10-year doesn't move from today? Like, as the equity guy, I find that a little bit harder to come up with what that scenario of this sort of immaculate disinflation is, which makes me a little twitchy and uncomfortable buying a bank into that environment. And again, we haven't had credit events yet. So how do you find someone who really is like, they're well capitalized and I can live through some credit, but basically I would say that my call is not one of big downdraft, big problems, more like we wobble and maybe I get a better chance to buy higher quality businesses cheaper.
We'll catch up with you later in the summer, no doubt. Jack, this was super thoughtful. It's good to see you as always. Jack Caffrey there of JP Morgan Asset Management. Equity futures on the S&P just about unchanged. Time now to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hackes. Hey, Yahira.
Hi, John. A new Bloomberg NEF report shows governments and companies need to spend $40 trillion more than they currently plan to in order to reach net zero emissions by 2025. Earlier this year, Bloomberg NEF had said global investment in the green transition surged in 2023 to nearly $2 trillion. But this latest report shows the pace of spending needs to accelerate as the world continues to warm and bigger solutions are needed. A key prosecution witness took the stand in the trial of Archegos founder Bill Wang, the former chief risk officer, testifying that once Wang decided on a trade, he did it again and again and again. Because of this, senior staffers would then greet each other saying Happy Groundhog Day in reference to the Bill Murray movie. Archegos' highly leveraged and concentrated bets on just a few companies resulted in a meltdown back in 2021, wiping out more than $30 billion of Wang's fortune and costing the banks it worked with $10 billion. And the NFL is considering new rules for team ownership, and Eli Manning wants in. The proposal would allow private equity firms to own minority stakes in franchises. Manning's Brand Velocity Group has said the firm is definitely interested in buying a stake of an NFL team, but the NFL has long held out in allowing private equity ownership. Currently, over 60 teams in North America are either backed by private equity firms or individual investors from that space. That's your Bloomberg Brief. John?
Interesting. Yahira, good to see you. We'll catch up with Yahira again in about 30 minutes' time. Up next on the program, NVIDIA's expanding reach.
It's not about just delivering a box. It's about delivering an entire infrastructure. And that entire infrastructure is insanely complex.
NVIDIA results just around the corner tomorrow afternoon. Fantastic job by Ed Ludlow just yesterday, sitting down with Jensen. Much more on that interview in just a moment. From New York this morning, good morning. Welcome to the program, live from New York, with equity futures on the S&P 500 just about unchanged after closing just short of all-time highs in yesterday's session. Yesterday, JP Morgan had its worst day of the month so far. The stock was down at the close by close to 5%. This morning, it's higher by 0.6. A lot of people waking up this morning talking about what he said about stock buybacks, talking about what Jamie said about succession plans. What we aren't talking about is the fact that they raised guidance. And what you're seeing this morning is a lot of upgrades to price targets. Piper going to 220 from 215, KBW 209 from 203, Baird 185 from 175. I'll give you the details of some of those calls in about an hour's time, but that's what you're seeing from the south side this morning off the back of Investor Day. Their stock is up by 0.6%. Under surveillance this morning, NVIDIA's expanding reach.
It's not about just delivering a box. It's about delivering an entire infrastructure. And that entire infrastructure is insanely complex. The last 30 years, both of our companies have changed a lot.
Here's the latest. NVIDIA partnering with Dell in a bid to spread AI to a wider range of customers. The announcement coming ahead of the company's highly anticipated earnings due out after the bell tomorrow. Bloomberg's Alex Webb joins us for more. Alex, let's start with the earnings and we can talk about the broader story of the last day or so. Just how high is the bar? That's the question we're all asking going into results tomorrow.
I mean, the numbers, when you look at them, are kind of mind-blowing. That the year-ago quarter had revenue in the order of $7 billion. The market's now looking for this quarter revenue of about $24 billion. Just kind of, triple what happened a year ago. the real focus then really is going to be on the upcoming quarter. I think it's looking for about $26 billion in revenue. Is the pace, can it maintain the pace of expansion that it has? What we've seen in the past few quarters is that everybody kind of expects NVIDIA to beat expectations, and anything less than that is likely to herald some disappointment.
Are we seeing, Alex, any kind of consolidation when it comes to just some of the demand for NVIDIA? We were talking to Mandeep Singh earlier, and he was saying that some of the advancement in the AI technology is bad news for NVIDIA because it means that some of the momentum has gravitated away from them.
Yeah, it's interesting, actually. It was also interesting hearing Sam Altman doing some interviews last week, because he actually said that if there are companies building businesses on essentially GPT-4, they might find that they're out of date within a year because GPT-5 is going to be that much better. So I wonder if that gives a little bit of pause, some hesitation to people then building on, AI businesses right now on Azure, the Microsoft Cloud, on AWS, on Google Cloud, and that has a knock-on effect on NVIDIA. The other point, of course, is the big cloud operators are the companies that are driving the revenue growth for NVIDIA. They are buying these chips in huge numbers. Are they going to continue doing that indefinitely? Well, the news we heard yesterday seems to be a sort of way of plugging that gap should it ever arrive.
Alex, in your mind, though, is there a bar, a number they need to surpass for tomorrow?
Well, no is the short answer. Anything that is above their expectations, right? Anything that is above the street's consensus, which is, I think, $24.5 billion, that's kind of what the market expects. Anything below that, it's likely to be punished. And the thing that's actually really interesting is that the options trading imply a move of as much as 7% as a reaction to the earnings. If that happens, that could move the market by 40 basis points, which is, again, kind of mind-boggling when you think about how big NVIDIA was just 18 months ago.
Alex, let's talk about the creepy story of the last 24 hours. According to Scarlett Johansson, OpenAI approached her. Sam Altman asked to use her voice for a new product service that they were launching. She declined. And then they went on, according to a statement, potentially to just develop a voice that sounded just like hers. Alex, what was your takeaway when you heard that news?
Not to get too sort of philosophical about it, the thing I find fascinating is, Scarlett Johansson did the voice for an AI sort of romantic voice, a sort of romantic relationship with an AI in the film Her about 11 years ago. The upshot of that film was actually slightly dystopian, and I find it so kind of bizarre that there are so many of these essentially dystopian movies or cultural references, and the tech executives lean into them, that they want to replicate this sort of actually slightly dystopian vision. That sometimes gives me a little bit of pause. Yeah, sure, it might be cool writ large, but the implications of it, does that mean they're not necessarily thinking about this in the way they should? Again, it's kind of a philosophical way of thinking about it, but still a strange disconnect.
No, not at all. I think you can go even further, Alex. What do you think the objective actually was?
I mean, honestly, I think it's probably as simple as Her was pretty cool, let's do that, right? And they do want, of course, the conversation with the AI to be really natural, to be conversational, essentially, that it's going to have a persistent presence, they hope, in your day-to-day life. There's been a certain amount of criticism about the flirtatiousness or the perceived flirtatiousness of the voice that they showed off at the event, a few days ago. That the sort of implications of who's designing this? Is it sort of male-dominated engineering, which therefore means that's what they think is attractive? There are all sorts of wrinkles within this, but it does seem as though it's been a little bit of a misstep on OpenAI's part, of which we haven't really seen all that many sort of big blow-ups like this in the rapid rise of the company.
Alex, there's also this broader issue of intellectual property. Essentially, the way that they generate a lot of their results is going to Scarlett Johansson and Her, or going to all of these other celebrities or these news sites that pay their people to generate this content. And they use that to generate answers, to generate some of the synopses that people are using in their high school classes for their reports. I'm just wondering at what point that becomes a real problem, where people can say, hey, you got to stop using my stuff. You can't just take it for free and then use it to really sell your wares.
So we already have quite a big test case in this space, which is, of course, the New York Times suing OpenAI. So when I said there haven't been any big blow-ups, that, of course, is a relatively meaningful one. They are suing OpenAI for using New York Times stories in developing their models. That will, I assume, be quite an important test case, because depending on how it, what the ruling ultimately is, and it'll probably take a fair bit of time until we get there, there could be a whole bunch of other content creators, from actors to media organizations, queuing up to demand something similar. This space is terribly fungible at the moment. People are trying to work out what the legal implications of everything are. The case that OpenAI and others make is that how is this any different from a human reading a New York Times story? I might read a New York Times story and then come on air and talk about it. How is that any different from an AI training its intellect on something that it reads elsewhere and then reproducing it for someone else? Now, that is a really grey area for which there isn't much legal precedent right now and has to be worked out.
Alex, thank you, sir, for the update. Appreciate it. Alex Webb of Bloomberg going into those earnings from NVIDIA tomorrow, and some of the controversy in the last 24 hours around OpenAI. Who makes money? Lawyers do. Isn't it always the way? Always.
Well, at a certain point in this case, they can get busy because there's a lot to go here in terms of the intellectual property. And yes, Scarlett Johansson is a particularly flashy story in terms of sort of the poster child of this, but it's going to go a lot further.
When you look at her statement, though, you get this essence that she didn't actually want to go the legal route. She said, we had a conversation about it, and I didn't want to give them my voice. And then OpenAI says, quote, we're sorry to Ms. Johansson that we didn't communicate better. Well, if they say that, does that insinuate that they did rip off our voice?
I find it really, really weird. Watch this space. More still to come, sure, on this front. Coming up next, Benjamin Netanyahu facing allegations of war crimes. We'll catch up with Israel's Strategic Affairs Minister Ron Dermer up next on the programme. From New York, this is Bloomberg. Let's get you a check of the price action. Welcome to the programme. Equity futures on the S&P just about unchanged on the Nasdaq with negative 0.05%. The fate of this week in the hand of one stock and one man. It's Jensen. NVIDIA is coming tomorrow afternoon after the close. That's the big one on the calendar for the week ahead. Looking at the Russell, the small caps down by 0.2%. All-time highs on the Nasdaq yesterday, just short of those on the S&P 500. Look out for one around the open in about 2 hours' time. In the bond market, plenty of Fed speak to digest and process. Yields pushing higher over the previous 3 days, just coming back over the last day or so. We're down 2 basis points to 4.4218 on a US 10-year on the session. On a 2-year, we're down 2 basis points at 4.8243. We'll get to the Fed speak in a moment. Let's just finish on foreign exchange. A sneak peek of G10 for you. This is the dollar against the euro, just a bit weaker against the stronger euro at 108.66. And the bulk of G10 doing okay against the US dollar this morning. Under surveillance, our top story, no doubt in financial markets once again. Another busy day of Fed speak. Barkin, Bostic, Barr, Collins, Waller, Williams and Mester all on deck. It's going to be Fed speak all over again. And you've said a few times, Lisa, front and centre for you this week, and Citi, Andrew Holmhorst saying the same thing, Governor Waller.
Whether he talks about what the long-term neutral rate is, they talk about the fact that, frankly, can they embrace the market's view that it is higher? Claudia Sahm put it well. You've had a lot of talking dots. This is essentially a group of people who are trying to put out there that they've got fewer rate cuts baked into the market. They have no certainty. They're not telling us anything new. She was just saying, just stop it already. I think probably a lot of people feeling the same. I do think, though, that we're going to hear something more from Chris Waller.
They're looking at the same data that we're looking at, and they're hearing the same guidance that we're getting from corporations as well. And some of it contradicts. Here's Macy's, delivering a beat on profit and boosting its outlook for the rest of the year. Part of Macy's plan includes closing some stores while opening up more Bloomingdale's. The better-than-expected results could buy time for CEO Tony Spring after a $6.6 billion buyout offer from Ark House Management and Brigade Capital Management. That stock is up by about 4% in the pre-market. Anne-Marie, you saw it straight away. Blue Mercury and what's happening with the high-end consumer seems to be supporting this business.
It is. You saw the increase in the spending there, 4.3%. That's what they came in for the comparable sales, while Bloomingdale's also a little bit higher, but Macy's actually fell when you look at the comparable sales. So you could see the consumers are still flocking to those luxury goods, which Bloomingdale's, Blue Mercury, quite expensive, a lot more expensive than, say, a flagship Macy's.
Next stop, Target. And Target is really, really interesting. Walmart numbers were pretty decent, but we talked with them about trade down trade down. Trade down from where? Are we going to be talking about Target struggling tomorrow and that's why they're cutting prices? I think that's the conversation this morning going into their release.
How much is just an execution issue and, frankly, competition with Walmart versus actual pressure from the consumer? This is a reason why it's so difficult to get any kind of clear read in the macro signals from some of these earnings reports. We see the potential restraint, consumer discretion in some of these reports, in the commentary from CEOs, but consumers are still shopping. They're still able to find those pockets of strength. Fine. Slowing but not slow, right? That's sort of the tone that we're hearing from a lot of these retailers.
Raising the outlook over at Macy's, but still talking about a discerning consumer. That's the latest on retail. Here's the latest out of the Middle East. A panel of judges will decide whether to grant applications to issue an arrest warrant for Israeli Prime Minister Benjamin Netanyahu on charges of war crimes. The International Criminal Court accusing Netanyahu of starvation of civilians as a method of warfare and intentionally directing attacks against a civilian population. I'm pleased to say that joining us right now is Ron Dermott, the Israeli Strategic Affairs Minister. Minister, once again, sir, thank you for sharing your time with us. Let's start with that story. The reaction from...
Good to be back on your show, John.
Fantastic to hear from you. The reaction from the President, Joe Biden, he called it outrageous. The Prime Minister, Netanyahu, called it a complete distortion of reality. Can you share with us, sir, what you believe the reality is and what Israel will do now?
Well, I agree with President Biden that it was outrageous. I'd also say that it was dangerous. Why is it outrageous? Because they're creating a false symmetry between Israel and Hamas, and they're basing it on false charges. As to the false symmetry, I think every fair-minded person realizes how absurd it is that you seek arrest warrants against the heads of a genocidal terror organization and the prime minister and defense minister of democracy that's fighting against terrorism. But the whole case, John, and you mentioned at the beginning, is based on a false charge that we have a policy of starving the Gazan population. Now, I'm in the war cabinet. We haven't had that policy from day one. So all of the charges are absurd. You're saying Israel's starving the population. We have put in 500,000 tons of humanitarian assistance, mostly food, into Gaza. We have paved roads to allow trucks, 20,000 trucks, to go into Gaza. So at a time when Hamas is actually stealing the humanitarian assistance, attacking the passage points, Israel is doing everything to enable the humanitarian assistance to come in. So all of these charges are baseless. The reason why I think, John, it's dangerous is because what it says to every terror group is that terrorism pays and that you can use human shields. You can attack a country, you can kill its civilians, you can then hide behind your own civilians, embed yourself in civilian areas, hospitals, schools, mosques. You know that's exactly what Hamas does. And the International Criminal Court won't go just after you. They're going to go after Israel, the country that's defending itself. This absurdity actually endangers all democracies who are in this battle against terrorism. And beyond that, I must tell you, I think it will fan the flames of anti-Semitism because people don't know what a ridiculous joke this whole thing is. So a lot of people will think, hey, the International Criminal Court, they've passed this decision. They're seeking arrest warrants against Israel. It has to be serious, right? It can't be baseless. So there must be something to it. And I think a lot of the anti-Semitism that you're seeing spread around the world, I think it's going to be on turbocharged right now. And that's why this is so dangerous. We were very pleased to hear a strong statement from President Biden, from other world leaders. I think serious countries pretty much don't take this seriously, and I hope that continues.
Minister, in October, the defense minister had this to say, quote, I have ordered a complete siege on the Gaza Strip. There will be no electricity, no food, no fuel. Everything is closed. Do you think that is evidence of a possible crime? That quote right there from October?
Absolutely not. What month are we in?
Well, this is what your defense minister said, that it was the plan.
Now you're saying the day after, we have 3,000 terrorists cross our border, murder our civilians, rape our women, burn babies. The defense minister goes out and says, we're shutting that down. You know why? Because we had an active war theater in the southern parts of Israel that took several days to actually get a handle of. Since then, what we've done, after the first few days of the war, we have enabled this humanitarian assistance to come into Gaza, 500,000 tons. Do you know that the percentage of water that Israel supplies to Gaza today is higher, actually significantly higher than it was on October 7th? We're the ones that are actually flooding humanitarian assistance into Gaza. Hamas is stealing that assistance and sometimes denying the population. But right now, the population has humanitarian assistance. They have food. They have water. They have medicine. That has been our policy since the beginning. And that's been the policy that the prime minister has led. A lot of people in Israel were angry about the policy. You know why? Because there's We're 250, now about 128 hostages that are still being held in Gaza. And they said, why are we responsible for providing all this humanitarian assistance? And the prime minister says we're going to act in accordance to international law. And that is what Israel has done from the beginning of this war. To have a policy of starvation and then to pave roads to allow thousands of trucks to go into Gaza, that makes no sense. It's the same thing when you accuse Israel of a charge of genocide when we're actually fighting a genocidal force. Everything has been flipped on its head. I think not only is it outrageous, it's dangerous. And what they did, it's like bringing Nuremberg trials. Yes, we'll put some Nazis on trial, but, let's have Winston Churchill and let's have FDR on trial, too, for the crimes that they supposedly committed during World War II. This is very dangerous for every democracy. I was glad to see very strong bipartisan opposition in the United States, led by the President of the United States against this. You saw Britain weigh in. You saw Germany weigh in. You saw other countries. And as I said, serious countries do not take these charges serious because they're not. This prosecutor, by the way, was supposed to come to Israel to actually get the facts. He is not interested in the facts. He was interested in defaming Israel, and the defamation of the Jews usually is what leads to physical attacks against the Jews. That's why I'm worried that this is going to lead to the spread of anti-Semitism. And this prosecutor, who frankly is a rogue prosecutor in what he did, he does not have jurisdiction over Israel, and he does not have jurisdiction of any of these cases. That's something that the American State Department and all the European countries have said from the beginning, that he does not have jurisdiction over this issue. The Palestinians are not a state. And Israel, he doesn't have jurisdiction over Israel. But this rogue prosecutor has gone forward. I hope that the court, the ICC, in order to save its own credibility, will not become a kangaroo court and will basically throw these charges out.
Minister, I'd love to talk about the policies going forward when it comes to Gaza and also the West Bank. I believe you still maintain that you're opposed to Palestinian Authority leadership in those areas, as well as you maintain that Israel does not want to reoccupy the West Bank and the Gaza Strip. So what is the plan, sir, for these two areas?
So what the prime minister said actually several months ago is that we don't want Israel to control civilian life within Gaza, and we don't want Hamas to control it. What we first have to do is we have to finish the job of dismantling Hamas's military machine in Gaza, and we're well on our way to doing it. We're operating in Rafah now. We're continuing that operation, and we need to finish that job. Once we finish the job of Hamas and taking out its essentially its army, then we have to work to getting an alternative in there. The truth of the matter is no alternative will come unless they know that Hamas is not going to be there. And what we'd like to see is civilians within Gaza that are not Hamas, that are not beholden to the Palestinian Authority, but Palestinian civilians in Gaza run their own affairs. As for security, Israel is going to have to retain overriding security responsibility because we're going to have to do anti-terror operations for some time to come. Look, we hope we don't have to do it. We hope there can be an alternative and they will go and fix the situation in Gaza. They'll be willing to fight against the terrorists and that Israel doesn't have to do it. But the Palestinian Authority right now is not fighting terrorism in the area it controls. And it's also educating the next generation of Palestinians, not for peace with Israel, but for war with Israel. That's why we don't want to see the PA go there. If the PA would totally change, would show that it's capable of fighting terrorism in the areas it controls, of educating the next generation for peace, that would be a totally different story. Unfortunately, that didn't happen.
Minister, there's a real question here about how you get not only international support, but Israeli support, because a lot of Israelis, an increasing number, are really pushing back and actually do want a plan to understand what's next when we get to another phase. Benny Gantz is saying that he is going to quit the war cabinet by June 8th unless there is a clear and a different war path, and he needs to see a government that will win the people's trust. What's your response? Why is the current government in its capacity not winning the people's trust in Israel?
Well, I frankly don't think that that's true. It might be the case, and I don't want to get into internal Israeli politics, that Mr. Gantz's plan is different than the plan that the prime minister has. There may be people in Israel who believe you should have the Palestinian Authority in Gaza. They may believe that you should create a Palestinian state. I must tell you, about 70-80% of the Israeli public actually reject that. And I think overwhelmingly there is support for the prime minister's policies. There are different views of what the day after should be in Gaza, but he has been very clear. He doesn't want Israel to reoccupy Gaza and to control it, and he doesn't want Hamas to be there. But in order to get to actually the day after, you got to get to the day after. You have to finish the job with Hamas. A lot of people are waiting on the sidelines, and they're looking, is Israel going to finish this? Is Hamas going to be there in the day after? Because we have tried. Actually, several weeks ago, there was an attempt to take local Gazans and to put them in charge of certain areas within Gaza. Guess what happened? they were killed and they were threatened. And therefore, no one wants to step forward unless they know for sure that Hamas is not going to be there. That's why it's so important for Israel to finish the operation, the military operation in Rafah, so we can move on to the next stage and not only win the war, but then talk about achieving peace.
Minister, just finally, I'd love a conversation, just an update on the current talks around the ceasefire for hostages. Where are we? Are those talks ongoing or have they completely collapsed?
Well, I don't know if I would say that they've completely collapsed. What happened is Hamas agreed to its own proposal. It's very interesting, John. They basically took a document and they said, we agree to what we're going to put on the table. But that document would effectively mean that it would be the end of the war. They could rebuild themselves militarily, retake control of Gaza, and essentially perpetrate, as they promised to do, October 7th attacks again and again and again. And no Israeli government is going to agree to it. We put an offer on the table several weeks ago. The Secretary of State, Tony Blinken, described it as a very generous offer. That offer still stands. I don't know if Hamas will take it. If they don't take it, we will continue our operations. We're always going to be prepared to stop at any point. And get our hostages out. And frankly, if Hamas tomorrow would surrender, would disarm, would give us our hostages, the war would be over. We have no desire to send our sons and daughters to fight in Gaza. But the problem is we have a terror organization there that is committed to our destruction and that is holding our hostages. So we will continue to prosecute this war until we win the war. And hopefully we will, in winning the war, as I see it, it's not just defeating Hamas militarily, ending its political rule in Gaza, ensuring that Gaza doesn't pose a threat to Israel. It's also bringing all our hostages home. We're committed to doing that.
Minister, I understand this is very, very sensitive given the families that are involved. What update do you have on the fate of some of these hostages? Are you aware if they're still alive, if they're healthy? What kind of communication have you received?
I think we have some pretty good intelligence about that. Unfortunately, John, not all of them are alive. I don't want to get into the specific numbers. We actually had an operation a few days ago where we were able to return 4 bodies to their families. And of course, that brings, as hard as it is when they were dead, but it brought peace and comfort, and they could close a chapter for those families and to be buried in Israel. We continue to do those things. We hope that we can bring our hostages out alive, as many as possible, as soon as possible. But it's a very, very difficult situation because they're kept deep underground, a lot of these hostages in the dungeons of Gaza, in these tunnels. A lot of the leaders of Hamas surround themselves with these hostages and use them as human shields. And that's why I think, again, why the prosecutor made such an outlandish, outrageous decision and why he is so bad for the overall battle against terror. Free societies everywhere. There should be a clear line between right and wrong and good and evil. There shouldn't be any comparison whatsoever between Israel and Hamas. And I don't think there should be false allegations that are really libels against Israel for a policy that never happened. No policy of starvation. It did not happen, and it will not happen. We are committed to abide fully by international law.
Minister, thanks for sharing your time with us this morning, and no doubt we'll catch up again soon. The Israeli Strategic Affairs Minister, Ron Dermer. Thank you, sir. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. There's just one big bear left on Wall Street after Morgan Stanley's Mike Wilson capitulated. JP Morgan's Marko Kolanovic held firm on his gloomy outlook on the equity market, urging clients not to buy stocks. The strategist cited a number of reasons, including high valuations, high interest rates, and elevated inflation, though he also acknowledged his outlook has hurt portfolio performance. JP Morgan has the lowest year-end target for the S&P 500 at 4,200. The index is up 11% so far this year, closing yesterday just above 5,300. The copper rally is starting to show signs of slowing, just one day after reaching an all-time high. Some have been warning that prices were running ahead of weak fundamentals as demand remains relatively tepid, especially by top buyer China, as their inventory levels remain high. The country's economic struggles remain in the spotlight, with data showing there's little sign of a turnaround in its troubled property sector. Those issues are seen as a major drag on consumption in the world's top metal-consuming country. And one person is dead and several others were injured on a Singapore Airlines flight that experienced severe turbulence. The Boeing 777 left from London's Heathrow Airport and, while en route to Singapore, made an emergency landing in Bangkok. The airline released a statement saying, quote, "Singapore Airlines offers its deepest condolences to the family of the deceased. We are working with the local authorities in Thailand to provide necessary medical assistance." That's your Bloomberg Brief. John?
Shocking news there. Absolute nightmare. Yahira, thank you. Much more from Yahira in about 30 minutes' time. Up next on the programme, a more discerning consumer.
I think weakness is starting to go up the income ladder, and that's what we're seeing. What I can't determine right now is how will companies react to that.
We'll try and get some clarity on that. Up next on the programme from New York, you're watching Bloomberg. Equity futures right now in the S&P 500 just about unchanged. Yields coming in a couple of basis points on a 10-year. Down 2 basis points, 442.18. A lot of price action from the retailers. Under surveillance this morning, a more discerning consumer.
Listen to the corporate calls. They're telling you that certain segments of the consumer base are already having problems. I think weakness is starting to go up the income ladder, and that's what we're seeing. What I can't determine right now is how will companies react to that.
So here's the latest. The news so far. Lowe's and Macy's out with earnings this morning. Lowe's beating sales estimates and Macy's beating profit estimates. The department store warning that consumers will remain, quote, discerning in their discretionary purchases. Chuck Grom of Gordon Haskett writing this. If trends have seen a further step down, this would suggest to us that deeper consumer issues are surfacing, which would be most problematic for the lower income off-price retailers. Chuck Grom is with us from Gordon Haskett now. Chuck, let's start with Macy's.
Hey,
what do you take away from a raise to guidance, but ultimately, once again, conveying that consumer is somewhat cautious?
Yeah, I mean, the Macy's numbers were decent this morning. Comps came in a little bit better. Gross margins, however, were weaker. They noted in their release they had to move some summer seasonal and spring seasonal items to get inventories in better shape. So that was smart for them. And then they essentially kept guidance intact. They nudged it up both the low end and the top end by about 5 cents. So what we can take care, and you can also look at the Lowe's numbers, which also came in a little bit better. You can see the pre-action on both stocks that the numbers weren't terrible or weren't much worse than expected. But we do agree. We think the consumer is discerning right now, and we expect that trend to probably continue for most of the year.
Were the numbers better than expected because these retailers are doing a good job at figuring out where consumers are willing to spend? Or are they better than expected because the consumers may be discerning, but they're still spending quite a bit?
Probably neither, actually. I mean, most of the beats are really below the line. And in case of Macy's, their SG&A rate was a little bit better. And in the case of Lowe's, the gross margin is actually a little bit better. And like I said, the top line pretty much intact, a little bit better. So we'll see how it plays out over the next few days. We have a lot of earnings coming up with Target and TJ tomorrow, followed by BJ's and Ross on Thursday, and then a lot more actually next week as well.
Chuck, when it comes to Macy's, we've been looking at the Bluemercury numbers versus flagship Macy's, and Bluemercury is doing very well. What does that tell you about the state of the consumer on the upper end and the lower end?
That's a great point, actually. Bluemercury numbers were up, I believe, 4.5% relative to Macy's being down. Bloomingdale's pretty much flat. I mean, I think what we're learning is the lower income customer is under the greatest amount of stress. The upper income customer, because of housing prices and where they are, and the wealth effect of the equity markets being strong over the past couple of years, are more resilient. That's not new. I think the question, and Mohammed pointed out in his comments, are we going to see the middle income start to come under pressure? And that's something we're going to, try to discern over the next few days and into next week.
Chuck, do you think Target might give us some information on that front?
Well, I mean, Target's numbers should come in close to expectations, down 3 to 4%. They did announce, surprisingly, a big rollback program, lowering the prices on close to 5,000 items. Is that reactionary? Is that proactive? We'll find out tomorrow. Given what Walmart's been doing on rollbacks, I think they noted that their rollback count is up 45% in the first quarter. And the consumer's looking for value and looking for lower prices. So it's intelligent on the part of Target to do that. Is that supplier funded? Is that coming out of their own pocket? That's something, we'll be looking for clarity on tomorrow morning.
Yeah, that's the margin question, Chuck. What's your base case on that question?
I think it's probably a combination of both. I think a lot of the suppliers are looking to move units. And I think that in that case, that, if it's similar to what we've heard out of Walmart, I think it's probably margin neutral. But again, we need to hear from the company to learn more on that. But like I said, I think it's a smart and proactive thing to do, given that The consumer wants value. Historically, Target's prices tend to be 5 to 10% higher than Walmart, so it's something they need to address, in our opinion. Are they funding that through their media network? Are they funding it through other parts? That's probably the case, is our assumption.
Chuck, when Walmart say trade down, are they saying trade down from Target? Is that who they're talking about? Who loses when they talk about that theme?
Yeah, I mean, it could be Kroger, it could be Target, it could be all the above. It's probably Target to a degree, though. I mean, that tends to be where the greatest customer overlap is. And as you heard from Walmart, the greatest share gains they had last week was on that upper income customer, the customer who makes more than $100,000 a year. And the key for Walmart, really, they saw this coming out of the global financial crisis 15 years ago, but they did not retain those customers. And that's the real opportunity for Walmart. And that's why they're doing more rollbacks. That's why they're investing in store remodels. So we think the prospects are good there for Walmart to retain those customers.
Interesting. Chuck, one of the best. Thank you, sir. Almost there. Feels like such a long earnings season. Chuck Crum there of Gordon Haskett breaking it down for you. Looking ahead, Lisa, to Target just around the corner tomorrow.
A real question of whether this is going to be an execution issue or a larger question on just generally customers. The point that he made about what was fueling profitability is a fascinating one. Does Walmart have more ability to cut prices because they are getting in more into entertainment? They're getting more into some of their online, in particular, sort of cyber aspects as well. Sort of interesting to see where the profits are actually coming from.
For Target tomorrow, do they have to eat it on the margin side of things, or is it the suppliers taking a hit? We'll find out tomorrow morning. That's going to be a big release for the retailers tomorrow. Looking forward to breaking that down for you. The third hour of Bloomberg Surveillance is just around the corner as well. We'll be catching up with Mike Wilson of Morgan Stanley after a big upgrade yesterday, Matt Lazzetti of Deutsche Bank, Luke Hickmore of Aberdeen, and David Rubenstein of the Carlyle Group. A stacked third hour of Bloomberg Surveillance coming up next, with equity futures on the S&P 500 just about unchanged. From New York, this is Bloomberg.
You've got a Wall Street that's waiting for something to break hard in one direction.
Our expectation is that we do kind of see growth slow through this year. We're seeing a slowing in the labor market.
There's still some anxiety, kind of in the system. I think a lot of it, to me, revolves around the labor market.
Realistically, we're just seeing a rebalancing in the labor market that's actually working out fairly well.
There are pockets of vulnerability, for sure. We're seeing that across the board.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance begins right now. Good morning to you all. A stacked 60 minutes coming right up, with equity futures on the S&P 500 totally unchanged and just a whisker from all-time highs. Coming up on the program this hour, we'll catch up with Morgan Stanley's Mike Wilson on his big upgrade of the last 24 hours. We'll speak to Deutsche Bank's Matt Lazzetti on the state of the labour market, and Aberdeen's Luke Hickmore on why he thinks the Fed should act sooner. We begin with the big issue. One of the street's biggest bears delivers a major upgrade. Morgan Stanley's Mike Wilson lifting his S&P 500 price target to 5,400, projecting a fresh record high. Wilson saying this: in short, macro outcomes have become increasingly hard to predict as data have become more volatile. We see this environment persisting, a view that's reflected in both our bull versus base case skew, which is wider than normal. Mike joins us now for more. Mike, good morning to you.
Good morning, John. How are you?
You know the headline to the last 24 hours is Mike Wilson's capitulated. He's moved from 4,500 to 5,400 and all of that. Can we just start with the skew, the wide range of outcomes? Because that was the headline of the piece. The bear case versus the bull case, has it ever been this wide?
Well, not for us. I think for other people, they've had wider skews. And look, it just reflects the uncertainty that has been the case for the last several years. And quite frankly, I wouldn't be surprised if we hit both sides. That's kind of the world we're in, which is, think about this year, and we talked about this at the beginning of the year, which is we had three sort of equally similar sort of outcomes. One was a soft landing, just the Goldilocks, which is kind of consensus now, and that's our house view. Then you have the no landing, which is kind of a reacceleration, the stickier inflation, even maybe a stagflationary outcome, which is what the market was thinking about in April. And now you're back to a soft landing, but you still can't rule out a recession either, right? So all of these are very possible, and they could all happen with a higher than normal degree. That, look, nobody knows anything, right? I mean, and particularly at a point it claims to, that's called humility, something that we've learned the hard way over life. But anyways, the point here is that the meat of our report this year, or this update, was really more about how do you make money. And you could have 20% upside or 20% downside. And that's what clients pay us for, right? It's the process. It's understanding, okay, what kind of environment and how are we going to navigate that specific sector ideas. That's not the headline that people want to write about. That's fine. That's your prerogative. But that's what we want to talk about.
That was never going to fit in the headline.
No.
We will talk about some of that stuff in just a moment. Let's talk about the headline just briefly.
Sure.
Are you de-emphasising the 5,400? Are you saying as a price target it's not actually that important to you and the firm? What is that?
Well, it's not important to most clients. Generation this year has been spectacular. The way we measure it with our client base, which is significant, is this is the best alpha generation, alpha capture we've seen since work in this environment. Oh, by the way, when we skew from these, like our house call is it's a soft landing Goldilocks outcome. We're not that confident that we want to make that bet fully. Like we think it's still late cycle still. We like staples over discretionary. We have two defensive sectors, overweight, utilities and staples, because that kind of protects against slowing growth risk. So there's a bunch of different things, but the main factor that's been working is quality. Quality's been the most consistent factor, and we don't see that changing.
I just want to say that if you wrote a headline saying nobody knows anything, I mean, we could do that every day, but it probably wouldn't really gain that much attraction. I am wondering if there are certain areas that would win in either scenario, the 5,400 or the 4,500.
Well, I think that we laid it out. Once again, that's our bear case. The 4,500 scenario that's not really our bear case. That's our base case for year end originally. That obviously has proven to be wrong, mainly because of multiples, right? I think this is the main thing, Lisa, that people have either gotten right or wrong in the last 12 months is that, I mean, a 21 multiple is, in the top decile of the last 80 years. I mean, that is an expensive multiple. So the question I think investors have to ask themselves is that a fair multiple to be paying? Well, in the Goldilocks, perfect soft landing, I think that's plausible. But that's where we're trading, and that's why there's not a lot of upside at the index level.
Which raises this question, are there specific sectors that win regardless of the overall index? Do you see certain areas that are kind of independent of this overall shift of whether there is this momentum and international money that pours in and keeps valuations high and sets them higher?
It's large cap quality. That is what continues. And by the way, it's not just high growth, it's also cyclicals can work in that, but it's still up the quality curve. And we show it in the note very clearly. I mean, it's been the best carry factor for the last year and a half, which is a classic late cycle winner, which is where we are. So, don't overthink that and don't try to be cute and say, well, I'm going to jump over here because I think there's better returns. There could be, look, in the small cap and in the lower quality areas, you can't own nothing. I mean, but it's very idiosyncratic. It's not a factor that's carrying well. It's okay, I have a stock specific idea. It's a low quality stock potentially that has a very unique story to itself.
Next big stop for this market, as you know, is tomorrow afternoon. We get numbers from NVIDIA. Mega cap tech, what supports that 5,400? What supports it for you? Is it mega cap tech, the NVIDIAs of this world? Is it elsewhere?
Well, it's basically you're assuming that multiples stay elevated, right? We didn't change our earnings forecast in this report, but we've had this sort of boom idea that we had the boom bust thesis for a while. We probably were early in calling for a recovery in earnings this year and in 2025. So that didn't change. So you have earnings coming from a lot of different groups now. I would say the biggest contributors have been technology. Energy has been a big contributor, surprisingly. Industrials, because of all the spending that's going on fiscally. So those are three major sectors that are contributing to the earnings story. But ultimately, the 5,400 is being supported by policy, right? By very loose fiscal and monetary policy. Now, you may say, well, monetary policy is tight. Not really. I mean, we have an incredible amount of liquidity coming in to pay for that fiscal. So to me, the risk in the story for the next 6 to 12 months is, do the markets start to balk at this unsustainable fiscal policy and the way that they're funding it? And we wrote about this, in detail. We have these liquidity provisions in place now, the reverse repo, which everybody knows about. The Treasury General Account can be drained if necessary to pay for fiscal stimulus in the budget if they need to. And the Fed has already said they're going to start tapering QT. Well, that's like $1 trillion of liquidity. That's pretty loose, right, to pay for the fiscal. So to me, and I think this is something we're watching very carefully. Last fall, when multiples came down hard, it was because rates were going up due to term premium widening, meaning the bond market was starting to push back on this strategy. Right now, that's not a problem. So one of the things we're going to be watching to change our view on how things trade at the index level is, does the term premium start to widen again? We don't know. But that's what we're going to be watching.
So big risk factor is in the bond market. And in the bond market, the big focus is November. Does this have a political twist to it? An election call embedded in it?
Well, I mean, yes and no, because I wouldn't say either party has shown any fiscal discipline, right? So in other words, I think we're going to get a strong fiscal support no matter who wins the election, both in Congress or at the presidential level. The real question for markets is, how does it get funded? How is it funded? Can they fund it at a reasonable rate? Right now, the bond market seems very relaxed about that feature, which is why multiples have expanded again.
So if the bond market stays relaxed about this, which there's a lot of people predict that it will, and believe me, I get very excited about auctions, but every week people tell me that I shouldn't because there's plenty of interest at these levels. If there isn't pushback, then 5,400, is that too conservative?
Maybe. It could be. I mean, look, I can make a case for 17 times, which is what our target was originally for this year, 17, 18 times. I can make a case for 21 times. I can make a case for 22 times. That's the problem, right? We don't know. So that's why we have a wider skew. And I would say this, Lisa, that the target will be more determined probably by multiples than we're going to be wildly surprised on earnings, okay? Unless it's a recession, of course, then you'll be surprised on the downside. But I don't like the earnings haven't really moved that much for 2024 and 25, right? If you think about since October, which is where the low last fall, 2024 earnings estimates are up a couple percent. The market's up 25, 30. So it's all multiple. So this is why you just need to be alert to things changing potentially in the bond market first, and then that will feed into the equity multiples.
When you talk about fiscal spending, to go back to John's point earlier, in the election, it's very different what the fiscal spending may be used on, depending on who wins the White House. You're talking about potentially industrials, the green energy economy. This is a new industrial policy from the Biden administration that could continue or could stop short if it's Trump. How are you thinking about 2025?
Well, I mean, look, I think the industrial policy will remain strong. I mean, that's a reshoring thing, which was part of the Trump administration. So half of the industrial policy is potentially green energy, and half of it, I would say, is reshoring and the deglobalization trend. So there's going to be spending either way. It may be redirected. Like I could see maybe the energy policy shifting back towards traditional energy, but I would be surprised if spending is curtailed in a meaningful way from that standpoint. I think we'll see changes or differences maybe in the tariffs, although recently that seemed to be more aligned. And then, of course, immigration is a big one. And that was a huge surprise this year that really nobody saw coming around the positive labor shock from immigration. So to me, that's probably the single biggest wild card, depending on who wins the election.
Bigger, not tighter, is the view coming from Alan Zentner and the team at Morgan Stanley. This economy can grow without it getting tighter and generating inflation pressure. Are you saying that could flip the other way pretty quickly based on the outcome of the election?
I think depending on how things behave, if policy really changes, but yeah, sure. If you all of a sudden shut the borders down and, Trump's talking about deporting people, that would be a negative labor shock. And then we'd be in a reverse situation. So, look, right now, I think the election is literally a 50-50. I mean, the polls are right there, 48, 49, 50% for both sides. So this is not an issue yet. We talked about this in the note too, which is that volatility in election years typically doesn't start picking up until August, September. So I think it'll be okay for the next month. This is not going to be a topic, but it can come at us quickly, probably post the conventions.
Mike, we've got a lot to talk about. You're going to stick with us. Mike Wilson of Morgan Stanley. Equity futures on the S&P 500 just about unchanged here. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Martin Gruenberg is stepping down as head of the FDIC after findings that the agency was a toxic workplace. Gruenberg faced mounting pressure following a scathing report that detailed allegations of harassment and discrimination during his tenure. The accounts come from a months-long probe into a Wall Street Journal article about female bank examiners facing a, quote, sexualized boys club environment. The White House said it will move quickly to nominate a successor. Donald Trump is closing the gap in fundraising with President Biden. Trump outraised Biden and the Democratic Party by $25 million in April, pulling in a total of $76 million. The boost comes on the heels of several high-profile fundraisers, including a Palm Beach event hosted by billionaire John Paulson. Overall, President Biden's campaign still holds a wide cash lead over Trump's. And Target announced it plans to reduce prices on around 5,000 popular items, including household staples such as milk, bread, fresh fruit, and vegetables. The company said it, quote, routinely adjusts its prices to ensure it is competitive within the markets it does business. Target is set to report earnings before the opening bell tomorrow. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Tomorrow morning, Target. Tomorrow afternoon, we'll hear from NVIDIA. Up next to the programme, the morning calls. And later, we'll catch up with Deutsche Bank's Matt Lazzetti and Aberdeen's Luke Hickmore. All of that still to come from New York. This is Bloomberg. The opening bell about 1 hour and 14 minutes away. Equity futures just about positive by 0.03%. Yields heading south by a single basis point on a 10-year 443.16. Let's get you some morning calls. First up, Piper Sandler raising its price target on JP Morgan to 220. The analyst highlighting news from Investor Day, including the bank's showcasing of a, quote, excellent management team. That'll get you access. We're up by 0.5% in the pre-market. It's a joke. It's a joke. Next up, Barclays upgrading HP to equal weight. The analyst seeing upside around artificial intelligence PCs to support the stock at higher levels. That stock is up by 0.75%. And finally, Stifel lowering its price target on Zoom to 65. While first quarter results beat expectations, the analyst citing a lack of year-over-year progress in its online business. We're down there by 2%. Still with us around the table here in New York, Morgan Stanley's Mike Wilson going into the opening bell in about an hour's time. Mike, we need to talk about NVIDIA after the close. My favourite question, is Jensen more important than Jay to this equity market?
I mean, this week for sure, because you have this big event with earnings, and the Fed's pretty quiet right now. They're in one of the reasons in the near term I think you'll not see a lot of movement in the broader market PEs is because we're in a quiet period now for the data, right? So the Fed has kind of done their thing. And of course, tomorrow night, all eyes are going to be on NVIDIA and what they say. I mean, look, I have no idea. I mean, like, our analyst is still bullish on the outlook, and I think most people are too. There's no reason to doubt that. I think the issue for AI, I think what, is, as I like to say, AI is everywhere except in the numbers. I mean, we haven't really seen a lot of impact yet. Now, that's fine. I mean, it's an investment part of the cycle. But of course, NVIDIA has been the big winner so far. There haven't been a lot of other big winners on the spend. There's a lot of spending going on, but it hasn't trickled down in a way that's rising the whole tide, right? So there's a lot of AI dollars out there, and they're being captured by various businesses. But what's been surprising to me is that the overall IT spending is sort of flattish to down, right? And that's the work off that we're seeing from the last 2 years. Now, when they first started talking about AI, and by the way, AI has been around for 30 years, right? Machine learning. We can talk about, this is not a new idea. It's just we have a new technology that makes it maybe more powerful. But I mean, a lot of the large tech companies said in January 2023 that we were going into a 2-year dearth of spending. And so AI is really just filling a hole, in some ways creating a bridge. So for me, the question on AI is that bridge long enough to get us to the other side? It's another big wild card in our outlook going into next year. Like, we don't think productivity is going to be impacted that much next year. It's more of a 26 and beyond question. So, how much is in the multiple now for this productivity improvement, which I think is coming, but could there be a disappointment next year on productivity from all this spending? And does that spending get a bit curtailed as people say, hey, we got to digest this a little bit? We don't know the answers. I don't think we're going to get those answers tomorrow night, because they're in the sweet spot of what's happening in the spending today.
You and the team have drawn a distinction between AI enablers and AI adopters, which I think is what you're basically sort of building out right now. Where are the AI adopters? Where are you waiting for that productivity boom that you think might be in the multiple, but you don't think it's going to happen for a while?
Well, we have a whole list of companies that we've laid out. We wrote a report back in February, March, kind of laying out the adopters, and worked with our analysts on this. And I think the market has jumped on that and has kind of price in a lot of upside for the adopters in some ways. What I'm excited about, John, are the adopters that we don't know about yet. Okay, when you think about the internet build out in the 90s, the big winners didn't really appear until the early 2000s. So we don't know who those companies are. Those are going to be your 10 baggers from here, right? They're probably private, or they're subsidiaries of larger companies, and it's going to be in a variety of industries, from healthcare to education to manufacturing, robotics, you name it. But boy, I think it's pretty early to identify those.
Jack Caffrey of JP Morgan was on earlier, and he was saying that this idea of going into some of the infrastructure, the energy grid, he feels like has gotten a bit over its skis because it's going to be so long before that gets built up and actually benefits from this. Do you agree?
Well, we're long utilities not because of that, but because we, sort of a defensive hedge. But they have benefited in that regard. We also upgraded energy, 2 or 3 months ago, on the idea that energy is probably underpriced. Now they both play into that idea. I think a lot of this stuff has been a little bit overpriced in many ways because there is a dearth of opportunities. Right, the last year and a half there haven't been a lot. I mean, any good theme has been latched onto because the overall growth in earnings has been somewhat subdued. Right, we haven't had a lot of earnings growth.
When do utilities not become defensive anymore if everyone's going into them for an AI play?
Well, probably now. I mean, it definitely feels like utilities, are getting. I don't think utilities are getting bid up nearly as much as, say, industrials or other sort of, ancillary sort of sectors or trades on the AI investment cycle. I mean, semiconductors is an obvious one, but there again, how many semiconductor companies are really showing, big AI spending upside? A handful. So I think, look, when the markets are in need of a theme and you get an exciting one like this, it will find every way it can to kind of extrapolate it to as many ideas as possible. And particularly in a momentum-driven market where you have a lot of retail participation, and you can push stuff around pretty easily.
But isn't there a big risk to AI? I mean, we saw it overnight when with ASML are reporting that they can just shut down the semiconductor factories that they have in Taiwan if China was to invade Taiwan. Does this concern you at all, these risks that surround this type of sector?
Well, I think, look, once again, semiconductors have probably been the single biggest beneficiary for this particular theme, yet we haven't really seen it yet in the numbers more broadly. Semi-cap equipment, some of the foundry players, and of course NVIDIA have been the clear winners of that. Which you mentioned a minute ago, a potential invasion of Taiwan is a totally separate concern. And that has surprised me, to be honest, in the last 6 or 12 months, that there's no risk premium built into the winners for that type of event. Like, we don't think it's a high risk, okay? But it's a risk, and it's out there, so there should be some risk premium built into that.
In about 8 minutes' time, we'll catch up with Mike McKee, our colleague, and we'll talk about the Fed Speak. The Fed Speak today, Barkin Waller Williams Bostic Barr. More Fed officials ultimately saying the same thing. You said earlier on, and I'd like to finish the conversation here if we can. You said earlier on that this Fed is not restrictive. Can you talk to me through why you believe that and why the Federal Reserve seems to take a completely different view of that particular question?
Well, what I would say is, the rates policy is definitely restrictive, right? The yield curve has been inverted now for almost 18 months, 19 months. And we're seeing the impact of that on, levered companies. That's why small caps have underperformed. Obviously, the regional banking system is still, not really growing because of the inversion of the curve. So I think their rate policy is restrictive. What I'm saying is policy collectively, right? When you combine the fiscal deficits of 7% and 8%, and then all the liquidity provisions that they put into place, some of that is delayed from 2021, right? The reverse repo is essentially a delayed QE program to pay for the fiscal spending. So the policy collectively, I would say, is not nearly as restrictive as perhaps the Fed would like, okay? I mean, it makes their job harder to get inflation down. It also makes it harder to get the economy to slow, which is their goal. Their goal was to slow the economy, not a recession, but slow it in a way where they could actually then start cutting rates. Because I believe we need rates lower to broaden out, right, the participation, not only from a corporate standpoint, but also from a consumer standpoint, right? Mortgage rates need to be lower. Credit card rates need to be lower, right? Mid-level, I don't know how anybody could. I mean, I think we're just willing to admit it. Over the next 6 to 12 months, from a macro standpoint, I think it's either 4 or 5 years, because this is hard. It's, coming out of the pandemic, we
24 hours, which you maybe shouldn't pay too much attention to, apparently. Coming up next on the programme, Deutsche Bank's Matt Lazzetti, Aberdeen's Luke Hickmore, looking ahead to all that Fed after his interviews yesterday with Mr. Bostic and Madam Mester. Looking forward to that. Ahead, central bank chiefs as well. All of that still coming up. Equity futures on the S&P 500, around about an hour or so away from the opening bell. Treading water. It has been an absolute snooze in terms of price action so far this morning, after closing just short of all-time highs in yesterday's session. From New York, this is Bloomberg. 60 minutes away from the opening bell in New York City. The opening bell just around the corner with equity futures just a touch negative. There's nothing to this. We're down by 0.03% on the Nasdaq. We're down about a tenth following 2 days of gains on the S&P 500. And yesterday, just building on a 4-week winning streak across the board here on the S&P and on the Nasdaq too. The Nasdaq at a record high coming into Tuesday. In the bond market, a 2-year, 10-year, 30-year. Looking for some data, and we won't get much this week. Looking ahead to the big week, which is a couple of weeks away. June 12th, CPI and a Federal Reserve decision. The big one for this market is Nvidia. That comes after the close tomorrow, so look out for that. Tons of Fed speak. We'll catch up with Mike McKee on that in just a moment. Yields are lower by 2 basis points on a session. On a 10-year, 442.57. Down a single basis point on a 2-year at 483.28. Just to finish things in foreign exchange, some ECB speak coming up shortly as well. Tomorrow, I think, Lisa. President Lagarde, what's left to say?
Well, what's left to say for any of them? I guess that maybe there's more uncertainty around the ECB, and maybe she could actually say something a little bit more in terms of how much they could diverge, what they care about the euro. She's not going to say any of that stuff. I'm talking about diverge from the Fed. People are basically unanimous in saying we need a little bit less, especially if you're coming out and saying we've got no conviction.
If you take a few of these central banks right now, it seems to me the ECB is the only one who's actually just said, June, yes, we're going to go. Most likely. After that, we don't know, but Bank of England's reluctant to say. Federal Reserve's been really vague given the economic data over the last quarter and a little bit. And the ECB seems to be the only one who's just sitting there saying, yeah, it's time to go. June. After that, we don't know, but see you in June.
It seems like maybe there's a little bit more conviction around that just because the economy there is slowing more clearly, or at least hasn't gained as much steam as in the U.S. At the same time, I just wonder really if it's going to be the path afterwards that matters the most. We get a lot of Fed speak. The idea of walking, talking dots that Claudia Sahm was talking about, to me, really speaks to just a complete lack of certainty, not just of when the takeoff is going to be, but how many come after that. And that, I think, just shows how different the Fed is right now.
The euro at the moment, 108.57. Under surveillance this morning, shares of Macy's and Lowe's rising in the pre-market. Lowe's reporting better than expected comparable sales for the first quarter. Macy's delivering a beat on profit while boosting its outlook. Target giving more insight into the consumer tomorrow. A big one for you tomorrow morning. Elsewhere, ASML and TSMC say they have the capability to disable advanced chip-making machines in the event that China invades Taiwan. Bloomberg reporting that ASML has reassured US officials of its ability to remotely disable its machines, for which TSMC is its biggest single client. In the event of a Chinese attack on Taiwan, ASML would remotely force a shutoff. AMH, quite a development in the last day or so on this front.
I would go back to what we heard from CSIS, which Bank of America put in earlier on in the year, one of their biggest risks, which is the fact that the Magnificent Seven companies like Apple, NVIDIA, they are so exposed to Taiwan. 90% of their chips are being made in Taiwan that they need to use, which is why you see all these concerns coming from the likes of the White House when it comes to companies like ASML, NVIDIA, TSMC. What happens if there is a Chinese attack on Taiwan, which Xi Jinping has said he wants to unify the country?
NVIDIA, if I haven't said it already, tomorrow afternoon, earnings tomorrow afternoon.
Really?
NVIDIA, yeah, apparently. After the close tomorrow. Parade of Fed speak continues. Williams, Bostic, Barkin, Barr, Waller, Collins and Mester all speaking today. Bloomberg's Michael McKee spoke to Cleveland Fed President Loretta Mester at the Bank of Atlanta conference just yesterday. She told him she no longer sees 3 rate cuts this year.
It's too soon to tell what path inflation's on, so we just need to collect more information on that. You know, last year people were worried about, the Fed may be getting too restrictive and therefore it's going to dampen the economy. Those risks went down. At the same time, the risks to inflation, I think, are tilted to the upside and remain so. And so that's the balancing that we have to do as we set policy going forward.
Mike McKee joins us now for more. Mike, wonderful interviews yesterday. What stood out for you?
Basically, the Fed officials are speaking with one voice now, that they don't think they're going to be cutting rates anytime soon. There's a slight disagreement about how many they might get in this year, if any at all. But they all seem resigned to the fact that this is going to be a long process and that the U.S. is going to be the outlier. The ECB can go ahead first, maybe the Bank of England, but the Fed is going to sit tight for several months.
Mike, given how many speakers you've spoken to and how many officials we've already heard from, how useful will minutes be tomorrow?
Well, they'll be useful in the sense that people will talk about, we hope we will see people talking about how long they expect inflation to remain elevated, whether they expect some sort of continued progress as we saw in the CPI. But beyond that, maybe some discussion of timing of cuts. But at this point, since everybody has been talking, it doesn't look like we will get a whole lot out of it.
Mike, I got to say, Mike Wilson from Morgan Stanley was on earlier, and he was talking about how the rate policy by the Fed is certainly restrictive, as they've said, but overall policy is not. And they point to some of the repo lines. They point to the balance sheet that really hasn't shrunk that much. Was there any discussion of that on Amelia Island at this conference?
Yes, there has been some discussion of that. And the basic feeling among Fed officials is that they are tight in the right way. As I heard the Mike Wilson interview, and he described what the Fed officials are seeing is their policies are weighing on spending and borrowing decisions because mortgage rates, car rates, credit card rates are high. So they're restrictive in that sense. They would say that the other facilities could be contributing a little bit to liquidity issues, but they're winding down. There's less use of the repo facility. The Fed continues to let its balance sheet run off, but the Fed can't do anything about the federal deficit. So that part of the spending is working against them at this point. But they have a policy of not commenting on things like that.
Mike, when it comes to gaining confidence, we heard from Claudia Sahm earlier. She says that they need 3 months. Is that the sense you get from Fed officials when you sit down with them? 3 months of data before they decide they're going to make that cut?
Yeah, a couple of people have said 3 months on the Fed, but most of them just say several months. But I think that's a fairly good interpretation of where they are with this. They probably aren't going to move. The market probably has it correct in betting they're not going to move until maybe September, which would give them the May numbers and the June numbers and the July numbers, which if they continue to show progress on inflation could lead them to start a rate cutting cycle. But they're going to need to see more progress than they've seen. I know you were talking about, John, the CPI on the 12th of June. That is the Fed's meeting date. Before then, they will probably have an idea of what they're going to do. May 31st, we get the PCE index, and that's expected to show continued progress. So they may keep moving forward, and they may get a little more optimistic in their commentary.
We get an update to the SEP that day as well. Mike McKee, thank you, sir. Fantastic work in the last 24 hours. Looking forward to more of it in the weeks to come. With us around the table, Deutsche Bank's Matt Lazzetti. Joining us also, Aberdeen's Luke Hickmore. Luke Hickmore, if I may go through the lineup again today. Williams, Bostic, Barkinbar, Waller, Collins and Schultz.
Yeah, it's tough, isn't it? I mean, we were talking about Table Mountain earlier in the year, and it feels they're all on deck chairs, waiting around at the top. Can't see a thing below them. It's useful to have all these Fed speakers with us now. I think there's early signs of it changing, and they need to see the data change. So I think this whole thing that Mike was talking about with the 3-month visibility period feels about right. September feels about right. But in a year's time, we'll be 100 basis points lower rates.
Matt Lazzetti, have you heard enough?
A Fed speak?
Yeah.
Yeah, I think we're hearing, obviously, a packed calendar today. A lot of it is not related to the outlook. We have a lot of commencement speeches on the docket. So I'm focused on a few things. One, we had Jefferson yesterday. I think hearing from the vice chair is important. He noted that the Fed's forecast essentially for core PCE at the end of this month is basically 26 basis points. We're talking about getting progress. That is definitely progress from the very strong prints that we had earlier this year. But we also have to know the context that it's still well above the Fed's objective. It still annualizes to above 3%. Today, I would highlight Governor Waller. In the past, he has given actually some decent forward guidance about the data he's looking at, the number of prints that he would likely to see. Perhaps he doesn't go that far. I think the Fed has fully pulled back from calendar-based guidance at this point in time. But the reality is the Fed is highly data dependent. Forecasting the high-frequency data is hard in this environment. And so the data should do more in terms of market moves than the Fed speak should.
Luke was saying that he thinks that you actually are starting to see a turn in the data. There is something going on under the hood that's consistent. Do you agree, Matt, that there is this feeling, not only disinflation, but weakness that's coming through maybe more than the overall data might suggest? Yeah,
you look at economic surprises, they're negative now on average. The inflation data did improve in the last month, but it's too high. The Fed needs a lot more evidence on that. Some caution I have around these 3-month rates that everybody's talking about. Everybody thinks that there's residual seasonality in the data. We get stronger prints earlier in the year. We get weaker prints in the back half of the year. If that is true, and I believe it is, the Fed should be cautious about overinterpreting 3 months of data if it does improve. Broadly, more broadly, you had some give back on the retail sales data. That was probably welcome from the Fed's perspective. You have a labor market that did soften a little bit, but the context is we grew above 3% last year. Atlanta Fed is tracking very strong GDP growth for Q2. It is softer, but it's not obvious at this point that it's soft enough to get inflation back down to target.
Softer, but not soft, as John's been talking about quite a bit. I am wondering, Luke, from your perspective, if there is a signal within specific areas like retail sales, where we see this discussion around more discretion, price cuts from Target, all of these types of things that are leaving us feeling like things might be shifting, but not enough to change the narrative. How do you interpret this?
Yeah, I'm that consumer thing too, but I'm also looking at what's going on with companies. Are they spending? Are their CapEx plans growing? And they're not. The federal budget is probably at peak for now. That's starting to be less of a stimulus going forward. So consumer may be stalling, maybe not going down, but stalling. Companies are happy to hang on to cash, quite frankly. And the federal government participation may be easing off a little bit. All of those are just those early warning signs. I mean, it may be that will passes in the next 2-3 months and we get back and stay at these levels of interest rates through next year. But I don't think that's where we are. I think we are in a period where that inverted yield curve is starting to bite, is hitting consumers, companies, and the fiscal side from the government's changing.
Matt, you write a lot about the labor market in your most recent note. What are these factors that can be a tight labor market but also low churn?
Yeah, so the labor market is fascinating at the moment. You have a very low unemployment rate. We're churning out 240,000 jobs per month on average over a 3, 6, 12-month period. At the same time, when you look at some of these other indicators, the quits rate, the hiring rate, it actually does show what looks like some weakness. The quits rate is the lowest since 2018. The hiring rate is the lowest since 2014. Those are typically associated with a much higher unemployment rate, probably something in the 4.5% to 5% range. So understanding what's going on there, I think, is absolutely critical. It is the result of a very low layoff rate. Now, I don't think it's just about labor hoarding. If it was just about labor hoarding, you expect productivity growth to be quite low. Productivity growth over the past year is actually quite strong. You expect people not to be working their workers very long hours. That's not really happening. So I think we don't understand it all that well. I speculate that this big burst in labor market churn that took place, basically everybody was able to quit their jobs around the pandemic. And it led to this much better matching between employers and employees. We also have a lot more flexibility in the labor market with work from home. If that's true, you should have less people quitting their jobs, less layoffs taking place, less hires, but also big productivity gains, which is at least is what we're seeing over the past year.
Mid-cycle adjustment. It's a phrase that I first read in your research. I think a lot of other people started to think about it in the months afterwards. You've put forward this idea that what we're going to get is a couple of cuts and maybe that's it. A higher neutral rate as well. What underpins that view? Where did that come from, Matt? Because the world seemingly is coming around to your perspective.
Yeah, so I think when you look at the Fed historically, oftentimes they are cutting because they are seeing recessionary dynamics at play. And when that happens, they cut aggressively. They cut well below what they think the neutral rate might be. We have 2 historical examples where they're not cutting because we have a weak economy, but they're cutting because maybe there's some downside risks or inflation has come off a lot. That's the mid-1990s and 2019. Both episodes had 3 25 basis point rate cuts. The mid-cycle adjustment. So as we look at the outlook, and if we think it is only about inflation, at least up front, I think it's more likely the Fed does, call it 325 basis points, pauses at that point in time until they either see some weakness in the economy or inflation is all the way back down to their target.
I'm going to get to Luke in just a second, but Matt, just to follow up then, doesn't a mid-cycle adjustment indicate that we have some idea of what the neutral rate is?
I think the mid-cycle adjustment gives you the sense that they think they're well above where the neutral rate is.
Are they?
I think, according to any metric, they are. I mean, I don't think it's as low as the 2.6% they have in their long-run dot plot. We think neutral in nominal terms is somewhere closer to 3.75 to 4, which is at the upper range of what everybody's saying. But we're still 150 basis points above that range. So I do think that they are restrictive from that perspective. I think it will flow through to the economy over time, and they can take out some insurance rate cuts. But there's massive uncertainty about where neutral is. And so just plowing forward to what they think neutral is probably not the correct path.
This is actually one of the critical questions for investors. And Luke, I'd love you to weigh in on this because we were talking to Mike Wilson earlier. And frankly, one of the biggest mysteries to him has been the interplay of incredibly loose fiscal policy and monetary policy that's restrictive when it comes to rates, but not necessarily beyond that with balance sheet issues and the repo lines. What's your take on just how much you're following what the Fed does, not just with rates, but beyond? And that interplay in order to just get more and more bullish because there's just still so much liquidity in the market.
You need that liquidity to be always increasing. And I think with that's behind us. I think we are going through balance sheet roll-off. I think we are going through that shift in how the Fed tries to control the economy. It's more interest rate-led than every other tool that they've used in the last 15-odd years. And that should start coming through. At the moment, it's not. You're right. Liquidity is massive. Credit markets are seeing new issues like we have never seen. And that's soaking up money too. But again, unless it's incrementally increasing, we will start to see that delta start to hit us over the next quarter, 2 quarters. I don't know. It will come through this year for sure. So it does come back, doesn't it, about do the Fed need to act? And are they better to start acting before they have to start acting? And as we were saying earlier on, normally we get fast rate cuts. This time it's slow rate cuts. I'd say 2 this year, 2, 3 next year. I'm probably a little lower than that. I think on the neutral rate, maybe 2.5 to 3 rather than something over 3.
Yeah.
But we do need to see evidence that inflation's okay into the long term as well.
Luke, I've got 10 seconds. Give us a trade. What's your favourite right now?
Short call AT1. 7.5%, 8%. No interest rate risk and very little risk of not being called.
Luke Hickmore, thank you, sir. Appreciate it. Deutsche Bank's Matt Lazzetti alongside him with Aberdeen's Luke Hickmore. Gents, appreciate it. Thank you. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Iran has chosen a date for its presidential election following the death of President Ebrahim Raisi. Elections will be held on June 28th with the candidate screening process set to begin next week. Individuals will be vetted by Iran's Guardian Council. For now, Iran's vice president will step in as acting president. A coalition of Tesla shareholders are calling Elon Musk's record pay deal an abysmal failure. Amalgamated Bank and 7 other signatories are calling on other investors to reject a $56 billion pay package for the CEO. They claim Musk is distracted by his other companies and is not serving the carmaker's best interest. Musk hit all the targets for the pay, but it was voided by a Delaware judge earlier this year. Now Tesla's board is putting the pay package to a vote for a second time to prove investors still support Musk's pay. And 1 person is dead and several others were injured on a Singapore Airlines flight that experienced severe turbulence. The Boeing 777 left from London's Heathrow Airport and while en route to Singapore made an emergency landing in Bangkok. The airline released a statement saying, quote, Singapore Airlines offers its deepest condolences to the family of the deceased. We are working with the local authorities in Thailand to provide necessary medical assistance. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, setting you up for the day and a week ahead. Plus, David Rubenstein of the Carlyle Group, just around the corner from New York. This is Bloomberg. Live from New York City, equity futures just a touch negative on the S&P 500, counting down to the opening bell. One less bear on Wall Street.
It just reflects the uncertainty that has been the case for the last several years. All of these are very possible, and you know, they could all happen with a higher than normal degree of certainty. So that's really the headline that should have been out, is that, look, nobody knows anything, right? I mean, and particularly at a point in time. And I think maybe our mistake is just admitting that we don't know as much as maybe everybody else claims to. That's called humility, something that we've learned the hard way over life.
Just fantastic to catch up with Morgan Stanley's Mike Wilson. Catch the full interview on Bloomberg.com and on the Bloomberg Terminal. Here's the trading diary for the day ahead. A host of Fed speak, including Waller, Bostic, Barr, Collins and Mester. The ECB's Christine Lagarde speaking tomorrow, plus results from Target and the number one stock to watch, Nvidia earnings after the bout tomorrow. I'm pleased to say that joining us now is David Rubenstein of the Carlyle Group. David, we'll talk about your new episode, sir, in just a moment. If I may, though, your view on Nvidia. When was the last time you saw the fate of almost an entire stock market come down to the earnings of one company?
Well, it's very rare when that happens, but clearly this one company has gotten an enormous amount of attention, and maybe deservedly so, but it is rare.
Do you sense that, David, based on that, this market is maybe validated being at all-time highs, or have things got somewhat stretched?
Well, I think You're talking about NVIDIA at the moment?
Yes, sir.
NVIDIA has really captured everybody's attention for its ability to be a proxy for where artificial intelligence is. And people who want to invest in artificial intelligence and take advantage of its growth potential and its profitability assume that NVIDIA is a proxy for that. For the moment, we probably don't have a better proxy than that. Oh, obviously, Microsoft and Facebook and other companies that are active in that space are also reasonable proxies as well. But NVIDIA is more of a pure AI play than the other companies. I think that it's rare to see a company go up this much on this sustained a basis forever. But for right now, it seems to be the flavor of the month on Wall Street, for sure.
It's been the flavour of the year, that's for sure. David, let's talk about the new episode as well. I believe you've been speaking to Sallie Krawcheck at a time where, for equity market investors who might not have participated in this record-breaking rally, they're unsure what to do. What was the takeaway from your latest conversation?
I had a conversation with Sallie Krawcheck. For those who don't know, she became famous initially on Wall Street for being on a Fortune magazine cover saying she was the last honest analyst on Wall Street. And that was because she was willing to go against the conventional wisdom on Wall Street, which often was to promote stocks for where there was a bit of a conflict of interest, because in those days you could be an analyst and also work for a company that was promoting or selling the stock. That obviously is gone now. But in those days, she was known for being a very, very tough analyst. Ultimately, Sandy Weill hired her to be the head of Smith Barney. And from that position, she later became the chief financial officer of Citi. And from that became the head of all of wealth management for Citi. And then later became the head of Merrill Lynch. She now runs a company called Ellevest, which is designed to help women invest their money. Her view is that women don't really know as much about investing their money as men. And she's designed a company that's designed to help them do that. And she also points out there's a gigantic wealth transfer of trillions of dollars that will occur over the next 10 or 20 years as men, generally who die before women, leave their estate to their spouse, and their spouse will inherit, or spouses will inherit staggering amounts of money, trillions of dollars. And she wants to make certain that women are better understand how to manage their money, because historically, she would say women don't manage their money as aggressively or as well as men do.
So is she helping women manage their money more aggressively? What's her advice?
Well, her advice is, of course, to invest with Ellevest and give your money to Ellevest to let it manage some of your money. But generally, she would say you need to make sure you know what you're investing in, have appropriate risk profiles for the amount of money you have and the time you have to invest it. She's hired mostly women to manage the money. She has a number of women who are well known, who are large investors. For example, Melinda Gates or Melody Hobson, among others, and Penny Pritzker also. And she's got a business that's smaller than the businesses that she ran before. She's managing roughly $2 billion, where before she was overseeing, tens and 20s of billions of dollars. So it's a smaller business, but she enjoys it because she feels she's doing something useful, which is to say not just making money for people on Wall Street the way she typically did, but doing it in a way that helps women. And she thinks that that's a very good social purpose.
David, we're looking forward to the conversation, sir. Thanks for sharing some of your time this morning. David Rubenstein there of the Carlyle Group. Look out for this one. You can watch more of David Rubenstein's interview with Ellevest Sallie Krawcheck on Bloomberg Wealth tonight at 9 p.m. Eastern on Bloomberg TV. Coming up tomorrow on this programme, we'll catch up with Citi's Andrew Hollenhorst, former World Bank President David Malpass, PIMCO's Erin Brown, and Vijay Rakesh of Mizuho. With NVIDIA earnings just around the corner, your equity market just short of all-time highs at a close yesterday. Equity futures just about unchanged this morning. From New York City, good morning to you all. Have a wonderful day. This was Bloomberg Surveillance.